the consumer is stretched here, right? We have to pay attention to that.
Whichever way you look at it, inflation is too high. The Fed has to rethink.
Rates can still move higher, and I think that's a really important thing for us to remember.
The market is not fully bought into this disinflationary trend idea.
I think we're actually going to go into a mild short recession going into next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Big day coming right up, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P slightly positive. Big data points a little bit later this morning. US retail sales. Before we get there, an ECB rate decision. And later on today, a deadline, TK, for a big union taking on the Detroit Three.
Huge day. I didn't even know where to begin with all that. I'll start with a count-up clock from inflation yesterday. The follow-on of people digging into inflation, John, clearly shows many see disinflation, and that's what Lagarde is to confront today. Is Europe going to see what the U.S. sees right now? If they raise rates today, are they doing it at exactly the wrong time?
Do we get a hike? We're split right down the middle. Just go into the economist estimates. There's some big banks out there calling for a hike from the ECB a little bit later this morning, Bramo. Citi, Bank of America, HSBC, Goldman, BNP Paribas. Take your pick. There's a long line of them, a long list, and I think that list is growing after what we've heard in the last couple of days.
I have to say, Kit Jukes put it the best, where he basically said the market has been pricing since the mid-year that the ECB is going to raise rates from the current 3.75% to 4%. The question is just how are they going to do it? Are they going to do it today and then hold and indicate a hold, or are they going to hold and then indicate they're going to raise rates further? The biggest surprise is any variation from that particular iteration of decisions.
You know, I think like the airlines yesterday, American Airlines, and what we're seeing there, I think Helene Becker joins us today, which is wonderful, an informed voice. But there is disinflation in the air. And yet in Europe, we're talking about inflation. And I just think this Thursday is a huge pivot point and a real point of tension.
Does this smell like disinflation to you? UAW, big union, taking on the Detroit Big Three with like 36% pay raises. This is what's on the table, according to the president of that union.
Even if you get the 20% you mentioned yesterday?
Ford has proposed 20% over 4 years. GM has offered 18%. Stellantis has offered 17.5%. And based on reports, TK, there's still a big gap between the two.
Huge gap.
And we might not close it by midnight.
Let's get the date calendar here. Amy told me 10 p.m. tonight is maybe where they get out front of this and pick a union. You know, there may be an announcement before midnight tonight. Cinderella's going to come out with a pumpkin, and before that, we're going to find out maybe.
The strategy, by the way, is quite interesting.
Yeah.
They won't name a location. It could be in several locations. It could be a limited strike initially. They won't tell you, Bramo, because they don't want to allow the manufacturers, the auto companies, to plan for the potential strike that could happen starting at midnight.
They want it to be maximally disruptive without the maximum economic hit. This is what I see. And so that's the reason why at 10 p.m., as Tom mentioned, you're going to hear from Sean Fain as he comes out and tries to detail where they might try to start the strike.
But with the news flow today, and I think for all of us on radio and television, it's like there's no countdown clock today. It's just never ending. It's going to go through the entire day.
I think we've got an ECB one, TK, to use.
Yeah, but then you listen to, I mean, I said to somebody yesterday, I said, this is maybe the most important press conference Lagarde's ever held.
It's certainly the most
IMF
uncertain
everything.
One. Yeah, an indecisive ECB. They've got to make a decision a little bit later today.
Somebody's going to go, well, you know, is Germany driving the bus or is Portugal driving the bus? And her answer will be interesting.
Well, if Germany was driving the bus, I'm not sure what they'd ask for, given where growth is
right
now
idea.
in Germany.
Yeah.
Traditionally, they'd be saying hike, given where inflation is, but they've got a tough economy.
This is a fascinating day. I'm going to also point out on the data, John, as you started, the VIX 13.30. These are terrible markets.
Well, let's get to it. Equity futures, given all the drama we just talked about, they are positive on the S&P 500 by 0.3%. Yields are a little bit higher by a single basis point, 425.85, and a euro TK going absolutely nowhere, 107.29.
Again, Swissy gives back here. It's not giving me a lot of angst and fear this morning. The major issue I have is, do you think the white titanium iPhone says me?
Oh, you're thinking about it?
Should I go?
This might happen.
They have like these subtle green, brown, darker titanium. Or should I really do a color reach and go for the white?
Are you doing a family plan?
I'm doing.
Is everyone else
when you got
upgraded?
vet and kennel fee, everybody else is on too.
Have you managed to construct this in a way that you're hardly paying any money?
I am. I think I have. And I did it off the Apple website, and they go right into the carriers. Dan Ives nailed this. nailed it. AT&T clearly is the most desperate, and the other two are sort of kind of like following on.
Are we going to find some space to talk about this later? Maybe.
Yeah, I'm just,
Perhaps.
I don't,
Okay.
I mean...
I have a feeling this is what you really want to talk about, not the ECB, not unions, not the data that's coming out a little bit later.
I just figure I can find a white
iPhones.
iPhone in a bar faster than a black one. You know?
Ramos, save us.
All right. Well, we're going to talk about maybe the time frame for some of the other decisions where Christine Lagarde's going to come out and talk about her iPhone purchases. No, she will not. 8:15 a.m. we get the ECB rate decision, followed by an 8:45 a.m. press conference. Christine Lagarde has a very difficult needle to thread. She is looking at inflation of about 5.3% in the euro region, still way too high. The expectation that they're only going to downgrade it to 3% next year. Stuck between a rock and a hard place. You got to imagine she might say the S word, stagflation, the nightmare of central banks. 8:30 a.m. we get U.S. PPI and retail sales. I am actually more interested in retail sales and the potential for a negative headline print, even with what we're seeing from gas prices that have been climbing. Auto prices and auto sales volume has been coming down. Again, can consumers keep absorbing the price increases that companies need to charge to break even, at least with the same types of margins? And at 11:59 is that deadline for UAW negotiations. I am watching the 10 p.m. Press conference of Sean Fain. I think that will be really interesting to understand their strategy, John, as you were talking about, of how they plan to wage a war against the auto manufacturers without losing enough clout in terms of wreaking economic havoc at a time of a pretty sensitive moment.
Got something like 14 hours to close that gap. Let's see if we can. Joining us now is Ben Gutterich, the investment director over at Invesco. Ben, wonderful to start the programme with you this morning. Let's start here. What is there to like about the US equity market currently?
Well, I think quite a bit, actually. You know, I think the backdrop is of resilient growth and a policy cohort that will probably decide to go on hold from here. That type of mix, resilient growth, more accommodative or less hawkish policy could fuel yet more gains in the US equity market. Of course, with all the other long-standing tailwinds for the US equity market, including sort of innovation and a place where shareholders can enjoy the spoils of that innovation as well.
Ben Gutterich, you were at Loughborough. Is that how you pronounce it, John? Loughborough, did you okay? Loughborough.
Nice.
Yeah, thank you.
That's right.
One of my heroes was there. Eric Pentecost is a giant in my mind in economics. Is the systems within the Eric Pentecost textbook, are they still in play? Like at Invesco every day, are you literally making up the theories as you go? Or is this actually finance and economics from our models of the past that we can use now?
Well, a fascinating reference. Doesn't come up much, but I mean, we're not making it up as we go along at Invesco. I can assure you of that. But my job isn't so much making economic forecasts as investment forecasts. And if our view is that rather than pinpoint economic forecasts, if the economy can be relatively resilient, coupled with policy that's as I say, it would take a hike, take a pause on hiking, and so is relatively more accommodative. That's like a nice tailwind. I mean, recessionary risks do linger as we move into next year. They're quite material, but for the time being, end of cycle stuff isn't such a bad period to be an equity.
Within your wheelhouse, and given what you just said about a resilient economy, does 60-40 work?
Well, I certainly think the 60 works. The 40 should do a bit better. I mean, clearly it's been a dreadful part of the portfolio for some 18 months. So that the maths of the bond component looks a bit more asymmetric. Looks like there should be a little less downside relative to the past. But also, if we have this sort of disinflationary narrative, and that the CPI report yesterday sort of supports the idea that it still is that the trends are still disinflationary ex-shelter, but that should sort of come through. Leading indicators on rent suggest that the shelter component can come down. Then a disinflationary backdrop would be okay for the 40 as well. It would always encourage a little bit more diversification and alternatives and real assets and a bit of cash, but not too troubled by a 60-40 portfolio.
Ben, it feels like trading the end of a cycle is like dancing on the head of a pin, trying to figure out when you can capitalize on the very tail end of the momentum, the increasing disinflation, the policy hold before recession sets in. How do you know when it's over, when the end of cycle season has just reached the end?
Well, I mean, that's sort of the point. Is it's very difficult to know. So sort of swinging too defensively is there are some risks in that, and I think end of cycle behaviour does lend itself to investors moving towards areas where there's more perceived areas of secure growth, and that would be like loosely defined technology, certainly US equities. But if you're of the view that the recession, all recessions are obviously awful, but that this recession, end of cycle event might be relatively mild versus those more recent recessions, then that encourages you to be a little bit more overweight equities. Yes, we've got to brace ourselves for volatility, but perhaps it might not be so punishing as in past end-of-cycle events. And that, as I said, encourages the modest overweight to equities.
The areas of growth that you mentioned are focused in the U.S., and you are overweight more in the U.S. than elsewhere. In Europe, where does that come from at a time where the ECB is facing stagflation, where the banks are passing along these higher rates without the prospect of more loans? You're facing a lot of headwinds, so how do you get enthusiastic about European equities?
Well, it's quite hard as you've laid out. Yeah, I mean the valuation is a starting point. But there isn't too much thereafter. Clearly, the economic headwinds are a bit challenging. Policy, it's on a knife edge, isn't it? But certainly, you would think, certainly based on how they behaved during that sort of financial crisis wobble at the start of the year, I think they want to show their inflation-fighting credentials. So policy not yet getting favourable, and clearly China. The impact that China has on the European economy also a challenge. So I would look to the ECB to get more accommodative and for Chinese policy to get firmly more stimulative before moving more assertively towards European equities. Maybe not too far away, but not at the moment.
Ben, just quickly, hike or no hike later this morning in 2 hours?
I would say hike.
Hike? OK. Ben, thank you. Ben Gutterich there of Invesco, joining the team. A long list of people looking for a hike a little bit later. The median outlook in our survey suggests no hike, but it's so split right now for the ECB. And a lot of people started to rethink about what we might get from the European Central Bank, because we get a set of forecasts a little bit later this morning. And we had a report from Reuters a couple of days ago suggesting that maybe in the 2024 forecast for inflation, that's revised higher to above 3%. TK, I've got some good news for a certain Manus Cranny, our friend from Dubai moving to New York. Do you want the good news?
Please.
Manhattan rents topping. Right on cue. So Manus Cranny is basically calling the top of the rental market in New York City.
He is. He's locked in for a 5-year, I don't know. He's got a view of the East River, and, he's got the whole thing.
All good stuff.
All good stuff. He's large. But thrilled to have Manus come here and bring, what the problem, folks, that you have with Manus Cranny is if you're at breakfast with John Ferro and Manus Cranny together, you only understand about one every 4 words,
You kept up yesterday.
Between the British accent and the Irish accent.
It's only slightly rude to the whole of the United Kingdom, Tom, and Ireland as well.
I'm offended, and I'm not even there.
Do you want the bad news, Bramo? It's still 4,400.
That's exactly what I was going to say.
Median rent for new leases signed last month, 4,400, unchanged from the record set in July, according to the appraiser Miller Samuel and brokerage Douglas Elliman. Yeah. I guess another spot of good news, Lisa, you would expect August to be really hot. And based on leases signed that I can see in this data, it wasn't that hot at all.
So the good news, as you said, that prices are topping out. The bad news is they're still up 35% from where they were in August 2021. So it still is really expensive, and they don't necessarily expect price declines. And this is something we heard from Jonathan Miller.
As I said yesterday, I think it was with Paul Sweeney in the 9 o'clock hour, and I said, when you're analyzing inflation, you got to wait a couple hours. You can't do it two minutes in.
To get the full breakdown.
You got to break it down like a David Rosenberg would do. And the answer is yes, services popped a little bit, core services. But the rest of it's going the other way, 3-month annualized. And if you take a present rent calculation, it's very 3-ish.
Very 3-ish. Is that what we're calling it?
3-ish.
Okay.
3-ish.
Lisa mentioned 35% higher from August 21.
That's the level up.
Up 7.3% from a year ago. So,
yay!
I'm not going to pretend it's any good.
Rate right now, maybe
Manhattan
3-ish.
rent. Terry Haynes of Pangaea joining us next on the looming UAW strike from New York City. Good morning.
We're making progress at each of the 3 negotiating tables, but as you just heard, we're still very far apart on our key priorities. To win, we're likely going to have to take action. We are preparing to strike these companies in a way they've never seen before.
The deadline is midnight tonight. That was UAW President Shawn Fain outlining the organization's plans to strike against the big three automakers as the negotiation deadline nears. On the table, an offer from UAW of a 36% pay raise coming back at them, according to President Fain. Ford proposed 20% raises over 4 years. GM offering 18%. Stellantis offering 17.5%. There's still a wide spread there, TK. Can we close it through the rest of today?
How Teamsters was that? I mean, I think the Teamsters thing a couple of weeks ago changed the debate, the tone, the body language of these people. This guy knows he's got his union behind him. Has
he got the president behind him too?
Don't know.
Emboldened by the White House as well.
That tone of voice, I didn't hear 2 or 3 years ago.
You know, have they really been emboldened by the White House? This is a damned if he does, damned if he doesn't kind of moment. And there hasn't been that much, based on a number of reports, there hasn't been that much involvement by the White House. They get involved and they fail to stave off some sort of strike. They're bad. Yeah. If they get involved and there is some sort of strike or they get to some resolution that hurts anyone, then they're bad. Like, either way, they're not going to be looked at well if they get involved.
There's a bit of lose-lose to this, TK, going into this one later.
Yeah. You talking ECB or you talking Joe? Or
no, I was talking about the strike that would potentially happen later on this evening, TK.
Yeah.
UAW. I didn't switch to the ECB.
I'm fascinated.
I can talk about the ECB if you want.
Who the company will be. That's lose-lose too.
What does she think about it?
But I'm fascinated who they pick is the strike company.
Maybe they go through three in different locations. The TK. I think they're being very cagey about the strategy because they don't want the automakers to plan for it.
Okay, we'll see. Terry Haynes will be up then. He'll be.
Let's see what Terry's call is: strike or no strike.
Right now, we've got a 2-hour conversation with Terry Haynes, a news flow out of Washington extraordinary. He's with Pangea Policy. I'm going to digress here because he's the only one that'll remember this, and then Lisa and John have some serious questions, including UAW. There we were, Terry, on the couch in 1968, and LBJ in Vietnam said, "I give up." David Ignatius dropped a bombshell 2 days ago. Amory Horton and I went back and forth on it right away. When is Biden going to do an LBJ?
Right now, I think never. They've put a situation in place here where he's the only alternative in the party. That there really isn't another alternative, and everybody else is staying on the bench. And you've got the Washington chattering classes going on about the need for change, but there's no alternative, and folks are not thrilled about the prospect of Biden standing aside and having a free-for-all that potentially.
But that's a Democratic Party. Come on, back to Grover Cleveland Alexander, the 2-term president in the 19th century. That's the way the Democrats do it. When have the Democrats ever been a smooth operation out of a campaign? They're supposed to have, a complete mess to get to the convention, right? In the smoke-filled rooms.
Well, historically, there are two things I could say about Democrats are, the first, insert the Will Rogers comment about belonging to no organized political party. The second, though, I will say that when it's time to whack somebody, as they say in New York, Democrats are much better at that than Republicans are. That said, I don't see the situation changing with President Biden anytime soon.
So, Terry, do you expect a strike or no strike? And how is this White House going to deal with it?
My instinct is, Lisa, and it is instinct, is no strike. And I will tell you why. Simply that they're not negotiating in public. That's always a good sign, whether you're talking about politics or union negotiations. And the union was very clear about kind of what they wanted, which was kind of get back in front of the wage train and protect their workers in an EV transition. By implication, they're also being clear about what sort of overreach there is. Number one. Number two, the automakers are motivated to have some sort of a resolution. And thirdly, as you all pointed out in the intro, lurking in the background is the White House, which very much wants a resolution, and I think we'll try to apply some pressure to get one.
Well, it seems like there hasn't been that much involvement from the White House. There were a number of reports talking about specific individuals involved, which haven't been at the very top. It's been the acting labor secretary, Julie Su. Again, they haven't really named a full labor secretary at this point, certainly not someone who's been out in front. Gene Sperling, a White House advisor, also has been a liaison to this. Other than that, there really hasn't been that much involvement. Do you think that that was a political mistake?
I think having Sperling and Sue involved is an indication of serious engagement by the White House. Gene's a very serious guy. The labor secretary you would expect to be involved, and she probably pushed to be involved. So, those seem to me like the right people. The question to me is what both rhetorically and in a bully pulpit sense Biden is willing to do. This is somebody who claims that he's the most pro-union president ever. So Franklin Roosevelt is spitting in his grave, among others. But that UAW created the American middle class and deserves an appropriate contract, and Biden sees the negotiation as essential to pushing the EV transition forward. For all those reasons, the White House is going to have to stay involved. I think you accurately pointed out the two bad choices, but and the downside is potentially worse than the upside. But they've got to get involved for the upside.
What is the ideal outcome for this White House?
No, the ideal is a contract that is accepted by all sides, that shows real movement forward, that the president can push to say this pushes my ideals about union ownership, union membership, union participation, and frankly, he gets the endorsement of the UAW, which has been hanging out there.
Right, Terry. I went back 2 years to Politico, looking at union discussions between Trump and Biden. Do you have any knowledge or perspective if UAW line workers are supporting the former president or the present president?
I don't have anything granular on that. I will say that there is has been for some time a major disconnect between what union leadership wants their rank and file to vote, or how they want them to vote, and how those rank and file actually vote. I mean, they're the same hotbeds in Detroit, in Pittsburgh, and the like are all places that were heavily for Trump and made the elections much closer than they did otherwise. I wouldn't expect that to change much, frankly.
Terry, got to go. Got a bit of breaking news, sir. Thanks for being with us. Terry Haynes there of Pangaea Policy on the latest with the strikes, potential strikes, a little bit later on today. Here's the breaking news for you. The reserve requirement ratio over at China gets a cut, a trim of 0.25 percentage points. The cut will be effective from September 15th. So a slight bit of easing, Tom, on the supply of credit, not necessarily the price of it, but ultimately easing the reserve requirement ratio for Chinese banks over in China.
Just in the last 24 hours against this, I mean, there's the whole financial thing, the property thing and that, and deflation, disinflation, all blah, blah, blah. You know what? A lot of the zeitgeist is the economy's still doing okay. We got to remind ourselves, is this a 3% China GDP, 5%? Dare I say, could it be more, even with all this financial upset?
4 is the number you hear a lot of, Tom. Yeah. A lot of revisions away from 5 towards 4. And Lisa put that on the long list of action we've seen from Chinese officials over the last couple of weeks, the last month.
Which is the reason why the moves have been, easing talk, easing light, not necessarily that aggressive, which raises a question how far they're going to go.
I think we need a surveillance road trip to Shanghai.
I'm sure you do.
3 of us on the deck there.
That doesn't shock me, Tom.
I can just see it, looking down the Bund.
Yeah.
Bramo on the Bund. I like that.
An easing posture over in China. Sarah Hewen of Standard Chartered on the ECB next. The PBOC out moments ago with a reserve requirement ratio cut, just a small one, 0.25 percentage points, but that on top of everything else we've seen from that nation over the last month. An easing posture out of China. Your equity market on the S&P 500 positive by 1/3%. Lots to look forward to. US retail sales, a strike deadline for Detroit's Big Three, and an ECB rate decision just around the corner. Equity futures higher on the Nasdaq, up by 0.4%. Into the bond market, the 2-year closed above 5% on Tuesday. broke back below it yesterday, still below it right now, up by a single basis point to 497.76. The 10-year 425.65. Tom, into retail sales a little bit later this morning.
Yeah, we got a count. Do we have a countdown clock for retail sales? Come on, we're slipping, Amy, in the control room. We need a countdown clock on retail sales, and we need a count-up clock from when the ECB announces to get to Lagarde's president.
You want to count up from it?
I want to count up. Lisa and I, you were gone
Lisa,
yesterday.
it doesn't have to make sense.
You were at a meeting. You were at a meeting yesterday.
He was saying this yesterday.
You were at a meeting yesterday with your people, and Lisa and I were like advocating for a count-up clock off of inflation.
You want to count up afterwards,
Yeah,
so you can say like 21 minutes since.
So McKee can give us further data.
Sure. All right.
You know,
we'll
it
work that
works
out, Tom. We'll figure that out.
Peter Cheer, with a really smart Zero Hedge, published it out of Academy of Securities, a really smart note
What did Pete say?
on real rates. He said real rates matter, and the key thing, Bram will comment on this. I usually look at the 10-year because I'm a lazy equity guy. He said the 5-year is more important. The 5-year real rate, inflation-adjusted rate, is what the pro over at Academy Securities looks at.
Everyone's been saying they want the belly of the curve, right? Isn't that the sort of consensus call right now? And so that perhaps is what Peter Scheer is talking about. No, Tom, he's not talking about you. He's talking about just in general. And this is something we keep seeing, John, as people try to capitalize on bonds that might not be trash, although Ray Dalio might think they're trash.
Everything's about you, Tom. Everything's about you. Don't worry about it. You'll upset him.
Dalio was what, at Milken?
Yeah.
I think so, yeah.
They interviewed him, and to get this right, he doesn't like bonds priced down yield.
Cash is no longer trash because cash
is no
has
longer
a yield.
trash.
And, yeah, basically.
I mean, look, Joe and Tracy interviewed Bill Gross, and it's like a legit deal. They're qualified. Bill Gross is running $1 gajillion.
You're suggesting that Ray Dalio is not qualified?
No, I just think Ray's. Come on.
Give us assessment.
Wait a minute. The last time we heard from Ray, cash was trash, right?
Something like that. That was a few years ago.
Okay,
that was a few years ago when rates
He
were at
moved
zero.
Okay.
Basically, there's a spare seat around the table, and Ray is welcome anytime. Is that the message you'd like to send?
Yeah, I think
Good.
Ray can come in and
Good.
we can clarify,
Okay.
clarify cash.
I'm pleased we've cleared that up. In foreign exchange, the euro has not had a close above 108 for about 2 weeks. We're at 107, 107.31.
What do you think
Totally
today?
unchanged. 8 weeks of dollar strength is what I think, TK.
Yeah.
And if you want a toxic brew, Lisa Abramowicz, then you've got one. You do not want a weaker euro and a higher crude price in Europe. That stuff is brutal. And that's where the ECB is right now.
If Christine Lagarde does not take a somewhat dire tone today, I think she'll be tone deaf. That's what I'm thinking, that she has to signal how difficult their decision is at a time where they want to support the euro, and they have to hike rates one more time in order to support the euro. But they also are dealing with a very difficult economic picture, downgrading growth with a German recession.
I totally agree with what you're saying in terms of oil. She's going to take a different tact for one reason only: oil.
Tough spot.
Yeah.
The energy story. Under surveillance this morning, the United Auto Workers and the big three automakers remaining far apart in talks on a new labour contract as the midnight deadline approaches. UAW President Sean Fain saying in a Facebook Live, "We are prepared to strike these companies in a way they've never seen before." The Ford CEO, Jim Farley, saying the union hasn't made a, quote, serious counteroffer to any of Ford's proposals, adding, "We're here, we're ready to negotiate, but it's sure hard to negotiate a contract, Tom, when there's no one to negotiate with."
Yeah, well, it's there, and it's Ford, and I don't know what they're going to do. Why do you go after the one company that didn't go bankrupt? Politically, to go after Ford, to me, would be odd, given the government challenges of the other
You think they
two.
pick one somewhere else?
The tradition is they pick one so they can strike longer. They can the fund that they have will last longer. This goes back 100 years.
If you wanted to maintain public support for what you were doing, pick the one which no one's ever heard of, Stellantis.
I don't
Doesn't that
disagree
make
with
sense?
that. No, John,
if you strike
I think you're onto
Stellantis
something.
and you're sort of somewhere, I don't know, pick a state wherever, and you've never heard of Stellantis,
Totally.
what does that even mean?
Which is the reason why, and I hate to read too much into a small price move, Stellantis shares are down pre-market.
I'd be
Ford
beating up on... No,
and
I'm
GM.
not-
Yeah. What are you going to beat up on? Go ahead, keep going.
I'm giving them my strategy for union negotiations. I'm probably not best placed to do that.
I think you're perfect.
Just a call on the ECB. The ECB rate decision 2 hours away, with markets split on whether President Lagarde will pause or deliver a 10th straight rate hike. Jeff Yu, BNY Mellon, one of our friends on this programme, weighing in, saying, quote, "We have to acknowledge the hawkish shift in expectations over the last 2 weeks. The risk-reward heading into the decision is not good for the euro. The euro is absolutely unchanged." And your third and final story, we're on IPO watch. SoftBank's arm pricing its IPO at the top end of the range, selling shares for $51 when trading begins on the chip designer later on this morning. The IPO is the biggest of the year, with Bloomberg reporting it was oversubscribed, Lisa, more than 10 times.
Still, though, just to give you some perspective, valuing the company substantially below the $64 billion of just a couple years ago at $54.5 billion. So, yes, substantially higher, but it's a small portion. And, Tom, honestly, you were right to point out this is basically a marketing shtick to try to get as many people into the market as possible. Bring up the screen again.
For those of you on radio, you're not missing it. Lisa's killing this. Bring it up again if you would, Amy. I don't know if it's not in the trash bin yet. Down at the bottom, there's all the numbers, the math, and all this. And John got merch when he went to the road show. Great. SoftBank maintains 90% stake. I still don't get this modern IPO stuff. What in God's name are they doing other than to cash out a bunch of bakers? Mizuho had a good day. Dominic Constam's probably buying breakfast.
Oh, Mizuho's making money on this, right?
Rashudo and Constam are buying breakfast.
Do you think you can learn anything from this IPO anyway, given the nature of the company that's being listed?
I'm not qualified to answer that. I defer to Anurag Rana.
Okay.
He was the one that would do it. Let's jump into it. We go to Europe, and I want John to lead this conversation because the first time I saw John Farrell was on the lawn of the Otmar Issing ECB building long ago and far away. Sarah Hewen qualified to talk about this most important
what I love about your story of meeting me? He forgets when we actually first met.
You got that right.
Years before that. Sarah Hewen, head of Europe and America's research at Standard Chartered. That's closer to the truth. Sarah, welcome to the program. Hike or no hike from the ECB in a few hours' time?
It's on a knife edge, isn't it? I mean, we think no hike. If you look at the data, the economy is close to stalling, if not already turning down. There's a very weak outlook for the for growth. Inflation, sure, it's still higher than it needs to be, but core inflation has come down, and we think that this sort of growth outlook will bring inflation pressures down further. The issue, of course, is the small nudge up that we've seen in inflation expectations, and importantly, the fact that the inflation forecasts for this time around are going to have to be revised quite substantially. It's quite tough. We recognise it's quite tough for Lagarde to say we're on hold, but by the way, we expect inflation to be higher this year and next year. So very much a knife edge.
Sarah, if Germany and a German recession can't bring down inflation, what will?
We'll get there in the end. I mean, recession ultimately will damage the labour market. It will dampen wage growth. It will restrict businesses' ability to pass on price increases, which has been a big part of the inflation story, don't forget. And you get to your 2% inflation target. I think what we're questioning is how far are they going to be focusing on their forecasts for next year's inflation, how far on the medium term, 2025. The forecasting horizon has always been 2 years. Where are we going to be in 2 years' time? If they up their forecasts for 2025 inflation, then that shows that they just don't believe they're not going to be able to meet the target as under the current policy stance.
Sarah, you're expert on this, and of course Standard Chartered has a wonderful European and particularly Eastern European look. How homogenous is the ECB today? Americans will go Germany, Portugal, or maybe we'll look at core and we'll say something about Italy or Greece. We're uninformed. Is it cohesive in a meeting today, or is it cats and dogs arguing that Lagarde never talks about?
I'm sure there are very robust discussions, put it that way. And I'm not sure that it necessarily relates to the domestic economies as well. There are really across the board weakness in the euro area to a lesser or greater extent. And the hawks on the ECB Council are not necessarily those that are in economies that are doing well. But there is a sort of big split. You can see very clearly that some policymakers are very concerned about the growth picture and feel very strongly that that is going to be bringing inflation down. They're really concerned that another rate hike will tip the economy into a deeper than necessary recession. Others just feel that you cannot stop while you have headline inflation and core inflation at 5.3%, sort of 2-3 times the target.
Right now, we're talking about how Christine Lagarde, the ECB president, is between a rock and a hard place. So, too, is the euro. And there's this real question of how much the ECB is watching the euro and hoping it stays at this level. What is the level at which the ECB starts to sweat about imported inflation at exactly the worst time?
I think that we're still some way from that. We've always seen in the past when the euro gets to parity that is the point at which we get verbal intervention. There are so many bigger problems, I would say, for the economy at the moment than the value of the euro. The euro is obviously helping the region's exporters. Imported inflation anyway is not what the policymakers are concerned about at the moment. They're concerned about domestically driven inflation. So even though we are seeing higher energy costs, and that is a worry, I think the concern over higher energy is equally balanced between the impact on inflation expectations, which will drive them higher, but also the drag on growth, the headwind to growth that in an environment which is already pretty much recessionary.
Do you expect Christine Lagarde to talk a lot about the long and variable lags that maybe are coming to the fore more quickly in Europe? Can you speak to how much they're going to speak about a hold being restrictive increasingly as time goes on?
I think that that's a very good point to make. As inflation comes down, if rates are staying unchanged, we can already see the impact on financing conditions, on credit availability, on the growth in the money supply, which has slowed very dramatically. So I think that they will emphasize the point that policy is restrictive and will stay restrictive for a long time. The mantra may well be that rate cuts are not on the horizon. They will want to send the message that higher for longer, rather than give any impression. Certainly, they won't give any impression today that they are done, and they will want to send the message that policy is set to stay restrictive until they are confident that the inflation target is within reach.
That decision about 90 minutes away. Sarah, thank you. Sarah Hewen there of Standard Chartered. It's about 30 minutes after that, you'll hear from President Lagarde in the ECB news conference, and somewhere in between you're going to get some forecasts from this European Central Bank, which could show inflation next year forecasted to be above 3%, which is why there are many economists out there predicting we get a rate hike from the ECB. Sarah Hewen is not one of them. Up next on this programme, Helene Becker of TD Cowen on the airlines. We've got to talk about the downgrades to the outlook that we've seen from Spirit, from American Airlines. The airlines this month on the S&P 500 down more than 8%. From the July highs, we're down more than 22%. Higher labour costs, Tom, higher fuel costs, and maybe even softer demand and lower ticket prices that they have to confront through the rest of this year.
And the partition of economy to business is just extraordinary how that's maintained. I look at one flight overnight, and the ratio of business fares to economy was 5 to 1. How do you run an airline with a 5 to 1 ratio between the cost of the fancy people up front and everybody else in back?
What's your go-to? Still New York to Paris?
No, I'm looking New York to Paris as a base fee. Everybody wants to go. Then also EWR
it's
to
not like
JFK.
A busy travel corridor in America. It's
no,
like
to LAX as well. New York
okay,
to LAX
cool.
as well. It's gone down. It's way down.
Like the glamour routes.
Way down. The kids are traveling like they're going to dinner in LA. They come back in the midnight.
Helene Becker of TD Cowen on the airlines coming up next from New York City this morning. Good morning to you all. US retail sales and ECB rate decision and a strike deadline later on for Detroit's Big Three. All of that is coming up.
We've already seen a lot more struggles with the pricing going forward as people are starting to pull back on their travel. So I think that is a big issue and why we think we're going to go to a recession. Higher energy prices is going to continue to cool spending by the consumer. As we approach $4 a gallon, I think that's going to conserve people's what they have to spend, and that's going to further lead to some weakness by consumer spending into the year end.
Earlier this summer, it felt so good to be an airline. Not to be a passenger on those airlines, to be an airline. That story has changed and changed quickly. We start September. On the month, we're down by more than 8% for the airlines on the S&P 500. That was Larry Adam there, the Chief Investment Officer over at Raymond James. TK, yesterday it was Spirit. It was American Airlines. It makes you wonder this morning, who's next?
Yeah, and the zeitgeist stuff, it's got to be United, Delta, maybe Alaska steps in that. John, I looked at the return of the S&P index. Thanks for your help on that. Where pre-pandemic, they're like negative 13%. At the bottom of the pandemic, when they got $1 gajillion worth of government support, they've made like 8% per year. In the last 10 years, this index is up 4.4% per year. Is that any way to run a business?
The chart of it's amazing. If you look at the run-up through the summer, oh, look, everyone's going to Greece. They're going to Italy. I'll pay anything. Please fly me there. And then all of a sudden...
And we did.
Fuel prices higher, Lisa. Labour unions want a slice of it. And now we're talking about softer demand and lower ticket prices too.
Where do they cut costs? This is my question, because they're still hiring people and having to offer up big to get people in the door to even keep the thing fully staffed. They've already cut your peanuts. They've already cut your the size of your seat. They've already cut your overhead compartment. They've already cut your line order. So at what point do they have the room to even begin to shrink expenses in a way that doesn't materially impact demand?
I love it when TK gets personal. The seats are ridiculous. TK flying business class. Just picture this. TK flying business class and there is still no space. I've got photos of it.
Yeah,
there is still no space.
I believe it.
I mean, I get on and the pilots look back through the door and laugh at me. But, I'm on the flight. We're going to keep the airline name out of this because I don't want Helene Becker in trouble. And the food was so bad. I said to them, why don't you just serve Swanson TV dinners? Just give us our youth.
But you pre-order. I pre-order with American.
Oh, do you?
I always pre-order with American, yeah.
You like the I got an email.
I like to pre-order,
that.
Yeah. Just get ahead of it. Get the meal that you want.
Okay, so, we blew up yesterday with American Airlines. Who knows today? Joining us now with experience, she has seen this before, with TD Cowen, Helene Becker. Helene, thank you so much for taking time out. I just want to go to the shot here, out 12 months, out 36 months. What's your single best buy of these beleaguered airlines at this moment?
Yeah, so we like Copa. It's a mid-cap airline company, Copa Airlines, based in Panama. They've got a 4% dividend yield, and their commitment is to raise the dividend, or to pay out 50% of adjusted net income. So every March they'll look at this year's net income and then adjust the dividend. We've moved away from the domestic U.S. airlines, as you know. Last time, Tom, I was here, it was United was our best idea. And we've kind of moved away because of the things you three have been talking about all morning. The idea that people aren't traveling as much, the hybrid work environment is coming to a bit of an end. You can't keep taking your kids out of school to go traveling every weekend.
Keep it up, Helene. Mrs. Keene's watching at home. Keep it going. Come on.
And so what winds up happening is demand goes down, and that's what the airlines are saying. We had our conference in Boston last Wednesday, and we had Alaskan, United, Sun Country, and Allegiant update. And then yesterday at another conference, we had American Spirit and Frontier.
Elaine, so you're in your conference. It's all friends, and I know that, and there's nobody watching, so we can talk frankly here. American comes out with a bombshell yesterday. What are Bastian and Kirby going to do? They got to go. And did they say, we're going to take the third flight from L.A. to Reno? It's gone? I mean, what is the to-do right now for these people after what they went through with the pandemic?
Yeah, it's really awful. I was in Washington earlier this week at a conference, and the message from the industry to government is you need to fix air traffic control, first and foremost. We're short 3,000 air traffic controllers in this country. We train a net about 500 or 600, which is a 5 to 6 year backlog. And that's just to keep things flat. We're down so much relative to where we should be. And it impacts the entire network because it causes airlines to burn extra fuel. They don't manage their they can't manage their day-to-day operations well. And from what can the airlines do? Well, they're not getting productivity improvements with these expensive contracts that they're giving. So the only thing they can do is keep raising prices, but that destroys demand. And the focus, I think, will be on more seats per departure, but they have all the wrong aircraft for that. So that means more CapEx at a higher interest rate. So the industry is getting its margins squeezed. There's not a lot they can do from an productivity perspective because they're doing less flying with more people. You've got fuel costs going up. Brent's over $90 a barrel right now, and that's not changing in the short term from what I've heard from our energy analysts. And so the outlook is really getting very concerning for these airlines because we're expecting 2024 to see flat to down earnings versus flat to up earnings.
Given some of the difficulties that you've just mentioned, Helene, do you believe the pandemic is a convenient scapegoat or the reason for some of those problems?
So I think I think they're using it as a scapegoat, but frankly, I think these problems existed before. You know, you guys who know, I've been talking about the looming pilot shortage for 10 years now, since December of 2013. And so when you think about that, we've been talking about the air traffic control shortage for 5 years. So nobody's paid attention. And now they're saying, oh, it's because of the pandemic. No, it's not. These problems were going to exist. The pandemic just intensified it and made it worse than it otherwise would have been by encouraging many people to retire 1 to 3 years ahead of time.
Helene, how much are airlines going to become credit card companies? And that's basically where they're going right now. Everyone has to get an American Express labeled with their corporate logo, and then they get all sorts of perks, and everybody who actually flies, forget about it.
Yeah, so that's a whole nother thing, because isn't Congress going through this this process right now where they want to change the whole way loyalty programs work and take away a lot of those benefits that airlines receive? But yes, that's the place where airlines make money, right? They can get remuneration from the credit card companies. They have the ancillary fees because once you have the airline ticket, they charge you for bags, they charge you for seat assignments, some airlines charge you for water, and so on. And so that's where the revenue benefits are going to come in, because those are high margin sectors of the revenue pie. But as far as ticket prices go, that's really what they have to do. They have to raise ticket prices to cover higher costs. And
yeah, but they're not. Come on, Helene, they're not raising prices. I mean, prices are coming down,
right?
Yeah.
Prices are coming down, so margins are getting squeezed, and that doesn't bode well for stock prices.
Is this a business? It's a crazy business.
Helene, do you want to answer that one? Is it?
Well, I've been doing it a long time, as you know, and I've seen this movie before, Jonathan, as you observed, and it doesn't end well.
Elaine Becker, when you say it doesn't end well, are you saying we're going to lose some airlines here?
I think at some point in the second half of the decade, the answer is yes. Not everybody's going to survive this looming downturn. Deja vu all over again.
Do you think we need mergers and acquisitions to avoid that?
Yes, absolutely. We need fewer. Having fewer airlines hasn't helped either, right? Because everybody complains about the service, and I complain too. I pre-ordered my meal on a flight home Friday night, and she gave it away. She gave it to another passenger who might have had more status on my flight than I did. But
did you kick up a fuss, Helene? I just want to understand how you responded to that. What did you say?
I said, you gave away my meal. What were you thinking?
Is she the one? Is she? If you're LAX to New York and they're landing in Kansas City, is it Helene Becker?
It's a thin line.
They didn't load my meal coming back from Jackson, going through Dallas.
Yeah, they didn't load mine either.
I was very relaxed about it. It's okay. It's
really
not their
annoying.
fault.
I'm getting more like they're so beleaguered. Every seat's taken.
Were you more relaxed about it so that they didn't land the plane in Kansas?
I was very relaxed about it because it was a few hours away.
And
I was going to eat at Dallas. The selection of food at the airport
finding on
there is
every
fantastic.
flight now. I mean, Helene's is the high ground on this, but what I find on every flight, there's always one idiot. And the flight
Tell us more. Who is that idiot?
Only
Are you talking about passengers or staff here?
But there's just always they're focused on one idiot who's like, we got to take care of him.
Kicking up a fuss.
Yeah.
Different cabins, TK. Helene Becker there of TD Cowen. That's usually in first.
Copa, Panama.
Yeah. Latin American Airlines are where it's at.
You go to Buenos Aires, which is a long ways away. We could do the show from Buenos Aires.
Straight down for
summer in Buenos Aires. November.
Make that happen, TK. Yeah,
we could do that.
Great exchange rate for you. Michael Schauer, Market Field.
Unclear what it is.
The consumer is stretched here, right? We have to pay attention to that.
Whichever way you look at it, inflation is too high. The Fed has to we think
rates can still move higher. And I think that's a really important thing for us to remember.
The market is not fully bought into this disinflationary trend idea.
I think we're actually going to go into a mild short recession going into next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market is positive. Near session highs up by 0.4%. Later on this morning, U.S. retail sales and jobless claims. Before we get there, an ECB rate decision. Later on tonight, Tom, we're expecting a news conference from UAW, the big union taking on Detroit's Big Three, because 2 hours after that, 10 p.m., that news conference potentially, Tom?
Yeah.
Midnight is that deadline to strike a deal with Detroit's Big Three.
I just went to our engineers in our control room, the team that we've got with their interns, and, they use GTP, GPT, and all that AI stuff. I want 3 countdown clocks today. We need 3
What are your 3 events?
8:30,
Data, the
10
ECB.
p.m. No, 8:30, like ECB economics.
Okay, we're counting up
10
from that.
p.m., like Lisa says, she's staying up for 10 p.m., when the union speaks, and then 12 midnight, we'll see if the Cinderella comes out and gives us a strike.
Pick a story. Data, ECB, strikes.
It's a tough call. It's a really good question because I think retail sales become more important because of inflation yesterday. But I got to go with ECB. I think from an historical standpoint, it's not, folks, for those of you in America, this isn't the Fed. It's going to be different.
So much harder for President Lagarde today. So, Lisa, let's go through what this ECB is stuck between. Inflation forecast for next year, which might be above 3% based on recent reporting. A growth outlook that may have to be downgraded based on what's going to happen with Germany, potentially a contraction for all of this year. Then you've got this rally in crude, this weakness in the euro, put it all together. Doesn't sound great, does it?
It's the nightmare for central banks, which is stagflation. It is the worst recipe that any central bank has to deal with, which raises the question, especially if the market is expecting the ECB to eventually, before the end of this year, get to 4% and then hold. Why not just raise to 4%? And then say, we're done. This is going to be something that will become increasingly restrictive over time. And we understand that inflation is a major problem. We also understand that we've got weakening growth. This is where we're going to sit and see what happens.
That's the ECB. Let's talk about negotiations here stateside between the Big Three and UAW. This is what's on the table at the moment. UAW started at 40% for a pay raise, came down to 36%. This is the offer so far, according to the union. Ford has proposed 20% raises over 4 years. GM has offered 18%, Stellantis has offered 17.5%. And Tom, there's a real feeling that we can't close the gap between now and tonight.
Based on the Bloomberg discussion yesterday, I'd say we can't close the gap. And to me, it's like the Teamsters. I said in the last hour, if you're the head of the union, how do you not behave like the Teamsters and just say, this is the way it's going to be, we're going on strike?
Why wouldn't you?
What are the consequences if they go on strike? They don't build cars. I get it. What happens on the inventory lots? I have not seen enough work about to the 3 automakers who gets hurt the hardest and how soon they get hurt.
From what we've heard about EV inventories, Lisa, maybe it wouldn't be a bad thing at some of these places.
Exactly. That actually they've got pretty hefty inventories, so they might be able to clear them out if the workers stop manufacturing. What's at risk for them to do this, Tom, is a good question, but there are some real things at risk, including moving factories out of union-friendly states, which we've already seen, to the south, possibly not necessarily getting the support of the White House if they're really pushed against the wall, if it creates too much economic damage. They could push too hard. And I think that is in the balance, and that seems to be evident.
Isn't Elon Musk and Tesla just sitting there rubbing their hands together, loving every second of this?
I imagine so. He was in Washington, D.C. talking about artificial intelligence, and he could afford to because he's not dealing with this.
Did you notice that they put Musk and Zuckerberg there in the East
Opposite
wing?
ends.
It's like a meeting with Putin. Putin with a long table where you sit at the end. And
if you want a nice read, Tom, during the show, because sometimes you're not following.
Some free time.
If you want a nice read, have a read of Secretary Granholm's trip across America in electric vehicles. That one is somewhat entertaining. Equity futures on the S&P 500 positive here by 0.4%. Everyone's sitting there now on Google. In the bond market, yields unchanged, 425.25, and in the FX market, Lisa, the euro basically unchanged, 107.36.
So the ECB decision, 8:15 a.m., 8:45 is the press conference with Christine Lagarde. Curious to see how much she sees inflation coming down by 2025, considering that the Reuters report has it at 3% by next year. 8:30 a.m. To me, this is the biggest deal, is retail sales in America. And we are going to get PPI as well and jobless claims, but retail sales will show how much consumer spending power has been eroded by higher gasoline prices and by inflation just more broadly. And we have seen gas prices rise to some of the highest levels going back more than a year. And 11:59 is the deadline for the negotiations, but we're all watching the 10 p.m. press conference with UAW President Sean Fain. Do they start to indicate that they're going to go after Stellantis in particular? Or is it going to be something targeting each of the particular big three because they want to make this unprecedented? They want to be able to say, we're going against all of you and demanding our right. How far can they push considering a weakening labor market and the fact that technology is moving out?
You should go and ask people on the street. There's going to be a strike at Stellantis, and they'd be like, what's Stellantis? Who is Stellantis?
A beer company?
It's Chrysler
Who is Stellantis?
Jeep. It's Chrysler Jeep.
No, they are. But do you
What's
think
the French company?
how many people in this country do you reckon who know who Stellantis
I think
are?
a lot of people don't. But isn't it like the French company Peugeot and it's
Peugeot?
Jeep? Yeah. Whatever.
Yeah, sure, whatever. Michael Schell, CEO of Market Field Asset Management. Whatever, just a European car manufacturer, Michael, it doesn't matter, whatever. Can we talk about these labour negotiations? And welcome to the programme. A question we've all been asking around this table is whether these are the dying embers of a hot labour market or something that's going to stay with us for a while into next year. Is this rear-view mirror stuff or forward-looking?
I mean, I think the auto workers are something of a special case. It's a small number of companies and it's highly skilled labour with a very organised union. So it's difficult to extrapolate from that and say this is the entire labour market. But I think as far as the labour market's concerned, it's still a very tight labour market. You're not creating jobs at the pace that you were. But there's absolutely no sign of that switch being flipped and for workers to start being laid off. So, I think power is still in the hand of a worker rather than the manager.
You synthesize equity, bonds, currencies, commodities, particularly a commodity analysis. Is $90 oil an opportunity for you, or is it the new market field headache?
I think it's an opportunity. I think that the energy sector remains very cheap versus oil. I think oil is moving higher. I think you had a lot of mistaken analysis earlier this year with people convincing themselves that you were going to have an extreme surplus in crude oil. And I think if you look at particularly U.S. inventory numbers, it's on the skimpy side. And demand seems to be okay. So, I think the way the market's priced, if crude can continue to move higher, get through that 93, 94 level that it stalled at last fall, I think the energy sector should follow.
Does that mean that is disinflationary or inflationary at a time where people are looking at retail sales to possibly come in with a negative read as a result of higher costs?
I think gasoline is still fundamentally affordable at current levels. I mean, the thing about gas is we sort of look at $3 gas, $4 gas, $5 gas, and over 15 years, it's really not the same number. So, a number which was really not affordable in 2008 and caused tremendous problems on top of a mortgage crisis. Look at what personal incomes have done in the last 15 years, whatever sort of metric, that you use. I think gas remains affordable at current levels.
Given that, it seems like you're a little more concerned about inflation going forward, a little more concerned about valuation in bonds right now, specifically the long end, than some people, talking about duration risk as more of a significant concern. Can you speak about how contrarian that has become as people sort of start to expect things to sort of have a soft landing and revert back to a lower inflation norm?
Yeah, I mean, I think, look, I saw you had a story about the inverted yield curve and how long it's been inverted. I mean, the way I look at that, it's a subsidy of long-term borrowers. In other words, the Fed wants rates at 5.25%, 5.5%, and the 10-year yield at 4.30 makes it much, much cheaper to issue long-term debt based off that benchmark. I think the danger that we have is that the long end of the curve starts to misbehave, that investors in the long end of the curve look for significantly higher yields. Fundamentally, there's no reason why the 10-year couldn't be at 5% instead of 4.3%. And then that is when monetary tightening starts to finally be transmitted to S&P 500 type companies. And as I say, I think that's the risk. I'm not worried about an organic slowdown in the US economy. There's no sign of demand falling off a cliff. It doesn't tend to just happen because the yield curve's inverted. I say if you look at we look at this sort of I call it an uneasy equilibrium. In other words, nothing's really happened for the last 90 days in any significant market. I think what would trouble me is if we start to see the long end of the curve really break out of its resistance levels.
Okay, well, I got to rip up the script here and go here. Mr. Dalio at Milken Institute agrees with you, and it's just simply we've got not a likelihood, but a sobering reality of price down, yield up. Does it solve itself quickly, where it's a one-off and we move back to some form of stability we've known, or is there real risk that we sit there for a while?
You know, I think that these things tend to break out and then continue where they are until there's a problem. So, as I say, if we saw, let's say, a 10-year yield around 5%, I think it would stay there until it causes economic damage, and then you're in a downturn, and then yields bottom. But I don't think we're going to go back and see...
Yeah, but John, help me here. What does a 5% shell yield do to the mortgage rate?
Well, it depends when your mortgage is up.
Well, no,
right?
But I mean within the present market of 2024, 2025.
Well, based on where
8%?
we are at the moment, so we know that the outstanding mortgages, something like 9%, are paying 6 and above at origination. TK, that's going to take a long, long time.
Yep.
So let's take mortgages out of it. Michael, can we live with 5%?
I think certain portions of the economy can and certain portions can't. As I say, it makes it harder to use leverage to generate income. Something like commercial real estate is much more vulnerable than residential real estate just because of the way that borrowing takes place in that industry.
Michael Schau, this was great, as always, of Market Field Asset Management. Looking ahead as well to UAW in this negotiation deadline with Detroit's Big Three. Bloomberg's Craig Trudell on the looming auto worker strike. He's going to be joining us very shortly. He'll be catching up with us in about 5 minutes' time. Plenty of economic data in America as well. Jobless claims, retail sales, PPI today as well, Lisa?
Yes.
PPI 2, all of that in a mix at 8:30 Eastern Time. Before we get there, at about 8:15, you'll hear from the ECB. Rate hike or no rate hike from the European Central Bank and President Christine Lagarde. 30 minutes after that, you'll hear from Christine Lagarde herself in a news conference in Frankfurt, Germany. If you are just joining the programme, welcome to the programme. Equity futures on the S&P positive here by 0.45%. Coming up, Madison Fuller of JP Morgan Investment Bank. TK, tons to talk about with her a little bit later in the next hour, about 48 minutes away.
Everybody's got to rewrite, redo. I mean, I'm sorry, it's Labor Day, it's the start of a new season. There's so much news flow here the first 15 days of September that somebody's actually got to publish a 10-page report. We believe. In every single asset management house right now.
That's what it starts with.
Is going, we believe.
We believe.
Michael knows it's garbage. We suggest.
We're guessing. We're guessing.
We
just
suggest.
Say, we're guessing. We're guessing.
We believe.
Do you want to throw in some national politics in America? New poll from the Washington Post, Monmouth.
Missed that.
46% of potential Republican primary voters in South Carolina support Trump. The state's former governor, Nikki Haley, she comes in second. Tom at 18, Tim Scott at 10, Ron DeSantis all the way back with 9%. All the way back. That's the spread right now. I know South Carolina is unique given Nikki Haley's presence there, but Tom, is that an indication of just how big the gap is between Trump and the rest?
Yeah,
of
absolutely.
The primaries?
You know, each state's different, but yeah, the answer is yes. That is an indication of where we're heading, and you know, it'll be interesting to see how Mr. Trump adapts to this, the language, who he supports, etc.
Does he have to adapt to anything?
Yeah, I think he's a cagey guy. He's seriously looking. He's going, okay, who's going to be my VP candidate? It's not going to be Mike Pence. You know,
you think?
Good call. Yeah, I'm trying, but the answer is, you know, he's going to be strategic about it. You know,
next year, it's going to be an interesting one, isn't it? Equity futures on the S&P positive here by 0.4%. There's a little bit of a lift in this equity market. Yields a tiny bit higher by not even a basis point. On your 10-year, 425.45. It is ECB rate decision day. Your euro is going absolutely nowhere. 107.33 from New York. Good morning.
The UAW northern part of the industrial belt part of the country is going to shrink no matter what. And in that situation, the incentives for the union are to get as absolute much as they can. This is going to be a difficult dynamic going forward for the economy.
Former Treasury Secretary Larry Summers on Wall Street Week with David Weston on the negotiations between UAW and Detroit's Big Three, and picking up on the sense of things that other people share, Tom, that perhaps this is the last big opportunity to extract as much as you can out of Detroit's Big Three. And it's interesting to hear from the likes of Ford bring up the very viability and sustainability of the company based on what's on the table at the moment.
It is. It's going to be, it's history making. And of course, all of this is the heritage. And critically to your good insight, John, Joe Biden is looking backward on this. I don't think he's looking forward. Yeah, he does the EV chat and that, but his heritage is so steeped out of Scranton in what, in my youth. And for him, it was, early politics. It's a huge backward look for the president. I don't say that in a mean way, but it's a lot of nostalgia going on.
If he's looking forward, TK, it's a 14-month time horizon. Let's be clear about that. The election just around the corner. Looking at markets right now, equity futures positive by 0.4%. There is a lift here. Yields unchanged on a 10-year, 425.25. Crude, new highs for 2023. Once again, just short of 90 on WTI, 89.68. TK, we're up here by a little more than 1%.
We're going to do something really special here. If you have a grandfather who grew up pretty darn poor and did pretty darn good, he would only drive a Cadillac. And that Cadillac, when you stepped in it as a little kid, had a plaque on the bottom of the door where you stepped in, and it said, Body by Fisher. We go to Lansing, Michigan. He happens to be in London, but our Craig Trudell lived the UAW. He lived Michigan, and he lives what Joe Biden remembers until Fisher Body went out of business, I think, I'll say the 80s, 90s, maybe 2005. Craig, really honored to have you on today. Is this UAW behind the President of the United States, or has he lost them?
I think the UAW absolutely appreciates that Biden is much more of an ally and an ally to be trusted than the alternative in Donald Trump, the front runner on the Republican side. That being said, this is not a sort of cut and dry story. I do think that there are concerns about the fact that Biden has this long history of not being able to necessarily deliver on what the UAW has wanted in the past under the Biden administration. And that being said, there wasn't much that Biden could do. This is a union that's been, weakening for some time and absolutely is trying to sort of mount a comeback from decades of having to give up a lot of concessions for the fact that these companies were upside down.
But I'm going to assume your family was involved with UAW 724 in Lansing, Michigan. It's a changed union. If you were to go into that union hall like your grandfather went in years ago, what would be the different body language today? I hear a lot of anger, like they're saying, we're going on strike.
Yeah, I mean, I mentioned, this idea that this union was dealing with the fact that these companies were upside down. They had, they were paying so much for, retiree health care and benefits that it was putting them at this huge disadvantage to the likes of Toyota and Honda in the U.S. We got to this point over the last couple of decades of, undoing so much of that problem that was sort of, keeping these companies back. And that's led to this, deep sense of resentment that even as these companies have, gotten to a place where they're in a much healthier position, there's sort of a feeling in places like Lansing, Michigan of, hey, wait a second, these companies are healthy on our backs, right? And we've seen, these companies pay, good wages, but, for new workers, much less than workers who've been around longer. And so, they don't want this tier system anymore. They want, the sort of pay and benefits that their predecessors in decades past were able to enjoy. And there's a real question of whether or not that's feasible in this sort of modern paradigm that we're in.
Let's say we can't close the gap. Let's talk about tomorrow. Craig, how do you organize, plan for the potential for a strike if you're Ford, GM, Stellantis, when you have no idea where those strikes will take place, at what scale, in which locations? How do you prepare for that?
I think it's such a tricky thing to prepare for, and very much by design on the part of the UAW so much about what we've seen with these negotiations have been unprecedented. It's a small thing, but in the past, you used to have the union and the car maker executives, shake hands over a table at the start of negotiations. The UAW said, we're not doing that. This time around, they're not picking one company at a time to target and to negotiate contracts with, and then trying to sort of replicate that contract with the other two. They're kind of, negotiating with all three and threatening to strike all three and be strategic about which plants they strike at, and to really sort of, put the management on the defensive and not know what's going to happen here. And so I think the short answer here is they can't plan for this, and it does, really complicate things and make it a lot messier than what we're used to.
And on the flip side, when does the UAW kill the golden goose? When do they go too far? Have people put a number on what levels then really break the backs of some of these companies in terms of profitability and competitiveness?
I think one of the really interesting questions here is, whether we get to a point where the UAW is able to negotiate contracts that are attractive enough to interest, the sort of next generation of battery workers that are going to make, what the workers used to make engines and transmissions in the U.S. that powered cars. Can the UAW sort of, get enough from these companies to leverage into organizing more of the U.S. auto industry? I think, in the past, because of the position that the union has been in of decades of concessions, there hasn't really been an ability for the UAW to go to the rest of the, industry and say, hey, come join the fold, be represented by the UAW after all these, years of givebacks. And I think that's one of the things that sort of, gets to the complication of, whether or not there is a competitiveness issue. The UAW would make the case that, yes, this would put these companies at a disadvantage, but we're going to go out and sort of, claim the next sort of, victim here. I don't think they would use that language, but they're going to try and leverage this into, organizing more of the EV and battery supply chain in the U.S.
Craig, I know you don't have the answer to this question, but I really want to understand how you're thinking about it. What does this industry look like in 10 years, given the spat that we're seeing with China and Europe and China, a big effort from the United States with the Inflation Reduction Act? What are we heading towards here over the next decade?
I think it's such a difficult time to really sort of answer that question. And I think that's one of the challenges coming into play here from both sides. For the union, you don't know whether you're negotiating with companies that within the years of this contract may have to close some plants that are building engines and transmissions because of this transition, from the combustion era to electric. You don't know to what extent consumers are going to, still want to drive, gas cars and be reluctant to go to electric vehicles. And the same can be said for the companies, right? You look at Ford, a company that, has made a lot of noise the last few years about the transition that they're going to make to EVs. Just in the last few months, really sort of changed its tune and put more emphasis on hybrids. And we saw that just this week with the Ford F-150 hybrid. So there is so much to be said for the uncertainty facing this industry going forward.
There is nothing easy about this. Craig, thank you, sir. Craig Trudell out of London on the latest. TK, nothing easy about it whatsoever.
That was fabulous. He lived it. He and his family
He's
lived
fantastic.
what Joe Biden's talking about.
Mark McCormick, TD Securities, up next. ECB rate decision, about an hour away. Equities on the S&P positive by 0.4%, 1 hour away from data in America. We'll talk about that data in just a moment. Equities up on the Nasdaq by 0.4%. A little bit later, a strike deadline for UAW, Stellantis, GM and Ford. All of that around the corner. Going into the ECB, your bond market's shaping up and looking like this. 2-year, 10-year, 30-year, 10-year, 426. Yields up a single basis point. 2-year, just shy of 5%, 498. 18, Tom, up a single basis point on the day.
Huge response to the kid from Lansing, Michigan being with us. Craig Trudell, I'm told, will join us tomorrow to see what we see tonight at 10 p.m. and midnight.
And we really don't know what we're going to see tonight at midnight. Just this big spread between what's on the table, something close to 20% from the auto manufacturers, and what UAW would like to see, which is 36 right now, Tom.
We'll see. I don't even know if we'll get the numbers tonight or that. We'll at least get some of the path forward here on strike and who's involved, including Stellantis.
45 minutes away from an ECB rate decision. The euro shaping up as follows. The euro against the dollar, 107.32 and going absolutely nowhere. Coming into this week, 8 consecutive weeks of dollar strength against a weaker euro. And Lisa, there are many, many reasons why that euro has been weaker.
You know, we're talking about the UAW strikes, and it pairs into this story, actually, because Europe is at the crux of so many of the difficult stories of some of the manufacturing questions of transformation with China. And they're just stuck between a rock and a hard place. How does the ECB handle and inject monetary policy into this mess, this toxic brew of different things? I mean, essentially, I can use that for this particular region with genuineness, because honestly, this is a difficult scene.
Javier Blas moving the market right now, making it more difficult for Christine Lagarde, for the president of the ECB. She's going to enjoy Brent crude breaking through $93 a barrel.
Toxic.
92.99 is not 93.00.
Get the euro on the screen and leave crude there. Crude at 93 and the euro at 107. And if Nomura's right, threatening to break down to 105. That is a terrible, terrible mix for the ECB and Christine Lagarde.
And I saw yesterday somebody modeling out a rationalization to get to 100 a barrel. My puny brain can't remember what it was, but in some form of futures market or looking at Saudi light, which I do follow, which is the Saudi Arabian light oil, you can extrapolate out. And right now we're at 100 a barrel under some measurements.
It's the rally that surprised big time.
That made no sense at all what I just said.
I'm moving on, Tom.
Move on.
Moving on. Building a bridge to the next segment.
Down
Under
in
surveillance
flames.
this morning. A slew of US data still to come, with PPI, retail sales and claims on deck. TK, it's the first time you've admitted that. Energy costs likely to put pressure
Javier
on
Blas is listening
prices.
over in Europe. He's going, what in God's name is
Retail sales expected to ease on depleted savings and student loan repayments upcoming. Jobless claims last week. 216,000.
Today.
Lowest since February.
We have a clock.
We're looking for 225 in about an hour from now. I want to turn to Europe. Different story. Important, though. China's lashing back at the European Union after Commission President Ursula von der Leyen announced a new probe into subsidies for China's EV makers. The country's Ministry of Commerce saying the sector has gained an advantage through, quote, hard work and its own strength. The threat of potential duties weighing further on Chinese EV makers in Hong Kong trading. We're down across the board there. This is some real tension here. How do these manufacturers in Europe compete with these companies in China? How do these manufacturers in America compete with these companies in China as they make this transition, Lisa, which is increasingly expensive on top of the wage demands happening here domestically?
Add on top of that, that China accounts for about 2/3 of global capacity for processing lithium, which is the main ingredient for a lot of the electric vehicle batteries. So they are coming at this with a strategic advantage from the outset, and they have just plowed into the European market. The European market is trying very late, to fight back with some sort of limitations to what the Chinese automakers are bringing in. The U.S. has already done that. You know, it's a little bit rich for China to be arguing this on a lot of levels, but I will just say this to me is a debate and frankly, a war that's very much worth watching and really goes to the crux of
I'm so glad you brought that up.
challenges.
I looked at it yesterday and burst out laughing. Are you kidding me? We're lecturing the Chinese a totalitarian regime on capitalism.
Precisely.
I felt like it was at Davos. You know, it's a Thursday night at Davos. Your third cocktail party. You don't know who you're talking to, and they're talking about stewarding responsible capitalism.
I'm totally with you.
Are you kidding me?
Europe's a mess, Tom. Europe wants to set the rules. Everyone else wants to make a business. The United States has said enough. Let's have the Inflation Reduction Act. Let's support this transition to EV.
Do we want EVs?
China,
I don't have a consensus on
centrally
this.
planned. Let's go. In Europe, it's like, slow down.
Yeah.
We don't have a plan yet.
Exactly.
Just follow the rules, please. Otherwise, you can't have access to this market. Just the European way. And to your point, does the demand even exist
I'm asking.
to make this transition?
I
These
live in a
governments
bubble.
are desperate, Tom, to convey their pro-climate credentials. For good reason, I understand all of that, but it's increasingly costly. The average family now, can they afford an EV?
No, they can't afford a new car. The issue is John and I live in a bubble, moving around in our Bentleys and our Ubers. You lead a real life, Bramo. Are people out there actually able to charge up EVs?
Yeah, actually, when you drive around and you look at all of the gas stations on, different highways, you can see EV chargers
And are
everywhere.
people lined up, waiting in line, arguing about how long it takes?
No, but at the same time, there are electric vehicles, even some dented ones, which means that they've had them for some time.
You've got to read the Granholm story.
This is another
If you read the Granholm story yet,
No,
you've got to read the Granholm story.
I'm not going to be doing it during the show.
Should I interview her again?
Please. Yes, let's do that again.
Good luck.
I don't think that's going to happen anytime soon. Rents in Manhattan, let's finish on that. Showing signs of levelling off. The median price for new leases was unchanged from July to August at $4,400 a month. The appraiser Miller Samuel saying new leases for August are down 14% from last year, may continue to fall. Median price in Brooklyn, remember that was cheap?
Yeah.
$3,850. Northwest Queens, record high, $3,900. The good news, they're not going up so much anymore. The bad news, they're still around $4,000 a month, Tom. Just brutal.
I'm popping the HP 12C here. We got the right calculator here. This is the one Mark McCormick would use. $4,400 a month is $52,800 a year. You got your taxes, federal, state, New York City tax.
What do you have to own?
Let's say, well, I'm going to go 30%. You get $176,000. You have to have $176,000 to pay roughly 1/3 of your income.
That's pre-tax. Pre-tax.
Yeah, pre-tax.
176.
Yeah, that's a big nut.
That's nuts.
It's nuts. It's not. And Jonathan Miller, we'll get him on here at some point with his great work. Mark McCormick's lived this. He's got 8,000 square feet overlooking the East River. He joins us right now with TD Securities. Mark, it's a breath of fresh air to have you on because we can actually talk about the markets and not this insane news flow. Bracket the euro right now. What is your conviction on where the euro will be 6 months from now?
So yeah, if we're going 6 months, we actually think euro will be higher, which is definitely out of consensus. It's not fitting the news flow. It's not fitting the themes that people are talking about. But these are the things that have been basically in flux the entire year. We started the year with strong U.S. data. Then we had the shift to the China reflation theme. Then we basically have moved back to King dollar through the summer with the bear steepening of the U.S. curve and essentially the focus on China real estate. But what's happening with the euro is really a function of what will happen with China and the U.S. evolving again on those themes in the next 6 months, which what we expect is by Q1 of next year, U.S. is in a recession. Fed is moving towards cutting rates. We think China starts to get its mojo back. We see the housing market and some of the financial indicators we're tracking in China are starting to stabilize. And while the ECB is basically going to be done around either now or at 4%, essentially the move for the euro will come through the combination of all these different global factors, which would help insulate it basically between this 107 to 110 range we've been trading. So on that perspective, a weaker U.S. economy is stabilizing China, basically reinforces topside euro 6 months from now.
Within that triangulation, what is the most opportunistic trade right now?
The opportunistic trade right now is actually interesting because it's not euro. It's actually playing the lines around the dollar. And I think one of the things that's been very interesting as a feature in FX is if you look at the dollar rebased through the entire year, it's done nothing. So it sits between a very strong LATAM and a very weak Scandinavian and even SEMA currencies where basically the dollar sandwiched in between the two of them. So if you think about the themes that are working, carries working, terms of trade, you talked a lot about commodities in your last segment. The relative divergence in commodities, energy's up 30% in 3 months, base metals is down. So if you think about the things that are working in FX, the trades that we like capture these different themes, especially relative growth. So we like Swiss franc lower against the Mexican peso. We like China renminbi lower against India. We also like sterling lower versus CAD. So those three are currency pairs are definitely ways of kind of not really looking at euro dollar, but playing all the different major global themes are actually very impactful and actually the things that are driving performance in FX.
Let's just sit on the euro side of the cross a little bit longer. Mark, in about 35 minutes, we'll hear from the ECB. 30 minutes after that, a news conference with Christine Lagarde. How toxic is it to see crude at the height of the year and the euro near the weekend of the range of the year as well?
Yeah, it's not a great backdrop. It does fit into the stagflation concept. I think part of it, though, is do we want to put too much evidence on one manufacturing PMI, one round of PMIs? What's interesting is the context around European growth has changed. Like, we're not looking for a recession early next year. And again, we're looking more for a bigger slowdown in the U.S. So if you think about the context of the growth, Germany's weak, but the other parts around Europe are actually quite strong. So I think for the ECB, the challenge here is, they're lagging behind the U.S. in terms of controlling inflation. They are dealing with elevated inflation numbers that they want to continue to keep inflation expectations in check, while again the economy's slowing. So our bias here is that this is a coin toss. We're leaning towards them actually not hiking. But again, maintaining credibility around the fact that they can hike once again. They are highly data dependent. And the other thing that's going to be very interesting for this release is U.S. retail sales comes in basically right around the time when the ECB is meeting. So we're going to deal with another very critical U.S. data dump because the dollar and the euro in particular are following hard economic data surprises, which means retail sales, inflation, industrial production, real data, not the survey, not the soft data, is what's driving the dollar. It's also what's driving the euro. So if we have the ECB essentially in our base case on hold, but essentially following market expectations that they hike, and we get the weak retail sales number we're looking for a very big downside miss in the control group, that actually stabilizes the euro, given where positioning and valuations are at in our models right now.
I've got to squeeze this in. You just threw out a bone. Let's put some meat on it. Did you just say the US is going to underperform Europe next year?
Yeah, we're actually looking for a significant slowdown. So I put it in this context from the base effects of where we're at now. If you look at the strength of the data, the strength of the narrative, the focus on like king dollar, U.S. exceptionalism, no one's even considering that the U.S. economy is going to slow into a recession next year. So our call is that the U.S. slows into recession, and as a result, you have to get much more Fed tightening. Because even if you basically go with the baseline here of where the Fed would go on pricing and where inflation goes, they're still in super restrictive territory. They're not actually changing their monetary policy stance if inflation drops and they only cut by the 100 rates that are priced in. So essentially in our call, U.S. slides in recession. We continue to lose momentum through the labor market, through the credit side, through the banking channel. And as a result, the U.S. slides into a recession early next year, which we're not looking for in Europe. And as a result, you get more Fed cuts than's priced in through 2024. And again, we're still not looking for the ECB to kind of move as aggressively. They're just kind of lagging behind. And China, again, is the other side of this, where a more supportive China environment would actually help to stabilize euro in a slowing U.S. environment.
It's quite a call. Mark McCormick, thank you, sir, of TD Securities. Yeah. If you're just tuning in, welcome to the programme. We're positive here on the S&P by 0.3%. The euro going absolutely nowhere, 107.32. That decision 32 minutes away, Bramo. That's quite a call from Mark McCormick. Recession in America next year. Outperformance, relatively speaking, from Europe, given Europe's position at the moment.
I think it's fair to say that that's contrarian at this point, especially
just a bit.
given where yields have been. It's pretty contrarian, although I will say his point about retail sales is notable, that the sort of barbell approach of retail sales in America expected to come in disappointing could offset some of whatever happens over in the ECB to at least give a bit of a reprieve to the euro.
Yeah, and we've hardly talked about it in the news flow today, but retail sales are going to be an eye-opener and frankly as valuable as what we saw yesterday in terms of lining up GDP.
Up first, retail sales a little bit
we
later.
Need 3 countdown clocks.
8:30 Eastern Time. Retail sales in America about 45 minutes away, 46 minutes away.
Yeah.
And then we've got jobless claims and PPI as well. Lots coming up a little bit later, including this. Patrick Anderson of Anderson Economic Group on the looming UAW strike.
We're making progress at each of the 3 negotiating tables, but as you just heard, we're still very far apart on our key priorities. To win, we're likely going to have to take action. We are preparing to strike these companies in a way they've never seen before.
That was the UAW President Sean Fain outlining the organization's plans to strike against the big 3 automakers. The deadline hours away. Some fantastic research has come out of the Anderson Economic Group over the last week or so, calculating this, Tom, that just 10 days of strikes against GM, Ford, Stellantis would reduce US GDP by $5.6 billion and likely push the Michigan economy into recession. That data, Tom, coming from the Anderson Economic Group.
We're going to get right to this. It's so important, and we are so honored. Our team has just done a killer job of giving you original, informed voices on this part of America. It was great to talk to Craig Trudell, growing up in Lansing, all of the Fisher body work that he knew in his family. And now we speak to someone also in Lansing, but truly expert on America's union and non-union auto business. Patrick Anderson owns the High Ground, the Anderson Economic Group. He is first call for everybody you can know at Honda, Toyota, obviously Detroit and Dearborn, and obviously a member of the Bow Tie of America card carrying
Is it a
group.
big club?
Thank you for the bow tie this morning.
It's a small
Patrick.
club, yes.
It's a small club and a suspect at that. Patrick, I want to take with you not the usual UAW blah, blah, blah right now, but I want to go down Interstate 75, down to Kentucky, down to non-union Auto America. Do they win with this UAW strike?
You are driving the correct road here, my friend, my well-dressed friend. This is the big issue. A bigger issue than how much of a wage increase you get this year is, do you have a sustainable set of companies that can win in a competitive marketplace 2 and 5 years from now? And in fact, you don't have to just go down I-75 and go on US 23. You have non-union automakers in Kentucky, in Ohio, in Georgia, in Alabama. You also have competitors in California. You have competitors in South Carolina. So yes, the most important competitive issue here isn't how much do you pay in wages. It's, can you sustain your company making products that Americans want to buy 2 and 5 years from now?
Mickey Maynard of the New York Times, she lived and breathed Michigan. She just owned it, Livonia, Michigan, and all that. And she wrote a classic article 15 years ago in the Times about the end of Detroit. Now, I guess they sort of salvaged it and things are okay. But do you, as a grizzled pro, worry about Michigan 10 years from now?
I worry about being grizzled, actually, but I also worry about Michigan 10 years from now. And that's why you see our coverage or our analysis point to the things that are structural. And why we pointed out that, for example, the request to go back to what's known as a jobs bank and a defined benefit pension plan are existential and bankruptcy risks for the automakers. And I absolutely understand this. And when I look at Detroit and I look at Chrysler and General Motors, I say there's no rescue coming if these companies go bankrupt again. And the goal here isn't to avoid a strike. The goal is to have a sustainable automobile industry. And when you see this kind of rhetoric and you see the kind of demands that UAW Sean Fain is making, you see it's a real risk. And at this point, basically, I mean, that $5.6 billion is probably an underestimate of the losses that will be incurred if the UAW goes out on strike.
Patrick, the research that you've done has been the research cited in every publication over the past couple of weeks as people try to understand what the ramifications of a potential unprecedented strike against all three of these automakers would be. Have you heard from the UAW itself?
No, we haven't. And this is all independent work by Anderson Economic Group. But of course, Detroit's a small town. And of course, I understand that they're reading it and talking about it. And I think some of the statements that come back are, in fact, comments on this. President Sean Fain made a comment yesterday about all those analysts being wrong. Well, I hope he wasn't talking about me. I actually never said that they don't have the right to strike, or never said that they don't have a reasonable request for higher damages, higher wages. But it's also clearly the case that when you go on strike, you are causing damage. That's the goal. And the first people that get damaged are your own workers. They lose wages. But all these suppliers, and in this case, auto dealers, one of the things that's different between this time and in 2019, when the UAW struck General Motors for 42 days, is there's very little inventory now. So if the UAW goes on strike, like they're threatening to do, within days, automobile dealers across the country won't be able to sell cars. Within a week, they'll have parts difficulties. And, you know, there are other car makers and other dealers out there that are representing Honda, Volkswagen, Toyota, Hyundai, Tesla, and customers will not be interrupted in buying those. So I hope the UAW and Ford and GM and Stellantis keep in mind the goal here is to have a sustainable, profitable industry that pays good wages and not just get, a quote win at the bargaining table or a big dollar amount. If you can't stay in business, you don't win a strike.
But Patrick, isn't that part of the strategy that we might hear at 10 p.m. today from Shawn Fain, that they're not going to go after all of them all at once? They're going to target things and that maybe try to just be selective about the damage so they can prolong the negotiations, kind of buying more time.
That is absolutely what this tactic has been announced. And I have to remind people that when you don't have a contract, the other side doesn't have a contract either. And this is not a de-escalation. This is an escalation. When you go out on strike and you decide to strike individual plants, what do you think the companies are going to do? I don't have an answer for that, but part of the answers are that you actually increase the damage and you harden the positions of the other people out there. Maybe they don't keep the plants open. Again, that's not my decision to make, but it's a real possibility.
Patrick, you're in Lansing. We had a really good conversation with our Craig Trudell, who grew up. His grandfather was Fisher Body with all the legacy there, World War II. Yeah. In the 50s, the 60s, the 70s, Cadillac boom. You know the story. And we had a great response. And a guy out on Twitter had a really smart note and his observation where he said, look, what's the union floor? Is it red or blue? And he suggested just possibly the union floor wasn't for President Biden. Is the union behind the president, or is he looking at another time and place?
A wild card in this, and something that I've pointed out and that Shawn Fain has pointed out, is something that we've never had before. We have huge taxpayer subsidies going to build battery electric plants, joint ventures with Chinese and other foreign automakers to build cars that right now represent substantially less than 10% of the U.S. market. And here, the auto workers and the taxpayers are actually kind of on the same side. There's a great deal of skepticism about whether this makes sense, about whether it's a good expenditure of taxpayer dollars. And for the point of view of the UAW and the automakers, it's an extremely risky business decision to invest so much and actually shut down plants that are making products that Americans are buying and that are making money for the automakers. So that's the wild card in this. It's not part of the wage demands, but it is definitely underneath it, and it's definitely worrying the White House, and it's definitely a wedge between the UAW, a traditional supporter of Democratic presidents, and this Democratic president.
Patrick, this was excellent. Thank you, sir. Patrick Anderson of the Anderson Economic Group. We'll be sending him a slim tie as well at some point.
Yeah, we
in
should.
The future.
Absolutely.
We should do that too. Just to mix it up a little bit.
Absolutely.
Brammer does not approve of that bow tie at all.
I mean, what are you talking about? Why is everyone projecting everything onto me?
Just the face we're pulling as you.
Thursday.
I think that
if we had the Bramo cam up, I'm sure it would show that Bramo did not approve.
I believe I saw that.
I think people should wear whatever they want to wear.
Okay.
Within reason, you know.
All right, sure.
Do you think he'd actually wear the skinny tie? I don't think he would. I think he'd use it.
Slim. Madison Fuller of JP Morgan Investment Bank is coming up a little bit later. We've got an ECB rate decision about 20 minutes away. After that, we've got some interesting economic data for you. We've got jobless claims, PPI, we've got retail sales as well.
Slow day.
And 15 minutes after all that data, you'll have a news conference with Christine Lagarde, Tom, the ECB president.
For those in America, this news conference is going to be really, really interesting. An opening statement, and then the Q&A, John. You've been in that room. Wow. It's going to be...
multiple questions, a lot of follow-ups.
I find it more enjoyable.
Get some notes. You know? That's what
I think McKee should go over and get the last question.
I'm anticipating that. Yeah. McKee on tour would be very cool.
Pretty good. Yeah.
That would be very cool. From New York City, this is Bloomberg.
I don't think we are close to stagflation at all. Look at the positive momentum in this economy.
The services piece, which is what Powell cares about, is still running much hotter than people expect and want.
Higher energy prices is going to continue to cool spending by the consumer.
The ammunition is drying up for the consumer to some extent.
The market is more worried about inflation than maybe it needs to be.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It's the quiet hour here on radio and television. Nothing going on except 3 countdown clocks and 14 minutes and change, an ECB ruling. John, I guess that trumps all, including what we see through the evening, the UAW strike possibly to come.
Well, let's deal with the next hour first, Tom. So in about 14 minutes, as you say, an ECB rate decision. 15 minutes after that decision, tons of data. Retail sales, PPI, jobless claims. 15 minutes after that, 8:45 Eastern Time, we have a news conference with Christine Lagarde, the ECB president. And, Tom, there are some banks out there who think this governing council is about to hike interest rates. Goldman is one. Citi is another. Bank of America, HSBC, they think the deposit rate could go to 4. I can tell you, based on a range of estimates at the moment, we are split right down the middle. And the reason things have changed is off the back of a report a couple of days ago from Reuters suggesting that people around this decision are going to be looking at forecasts showing CPI next year not above 2%, above 3% for 2024. Does that change the calculation that this ECB needs to make in 14 minutes?
What's the so what for Americans? And the answer is it's right now a global movable feast. Action in China today on rates. Even Ukraine had a rate adjustment lower as well. And I would suggest what happens in Frankfurt here in 13 minutes, 7 seconds, it does affect Chairman Powell. It does affect America.
I would say this, that Frankfurt is exposed to all the wrong stories in a way that the United States is not. The slowdown in China, the fragility in the energy market. Think about what Europe's exposed to on the energy side at the moment. The United States, thank goodness, has output near all-time highs in America right now for crude. That's the good news. The bad news for Europe, Brent's in the 90s. The euro is weakening. Germany's potentially in recession for the whole of this year based on forecasts we're going to get from the German government. And inflation is sticky high.
Okay, give me Brent intraday here. Lisa, right now Lagarde's looking at her Bloomberg terminal in Frankfurt. She's got the one with the big screens, you know, like 4 screens.
With everybody
and all that. And she's looking at Brent crude, $93.18. Brent is on the move this morning.
They have a very difficult situation right now. And the key question to me is how much of this is a global story and how much is a Europe-specific story? What is the differentiation of inflation in Europe versus the U.S.? Are we seeing disinflation at a time where wages are going up, where services sectors are still sort of leading, but sort of kind of falling off as well in Europe? Right now, it seems like the market is expecting the ECB to get to 4% by the end of this year. Why not go now and then just say we are now done for the foreseeable future, and we are going to see how much damage is being inflicted?
John, Brent crude in euros, we usually don't talk about that, in euros, from the end of June, up 31%, annualized up 261%. What else do you need?
Nailed it.
This
is why it's so toxic, Tom. To have Brent at 93, the euro at 107, and if Nomura's right, we're going to 105 and it gets worse. This is a mix, the blend you don't want to see at the ECB. Energy prices picking up again, just as the euro starts to weaken again because the economy's not doing well.
Data check. I'm going to go right back to Brent crude here. $93.16, up $1.28. You're going to get a 90 print on NYMEX here in moments.
Totally unchanged on the euro into this decision. 12 minutes away. 107.30 against the dollar. Yields a little bit higher on a 10-year in America, up a single basis point to 425.85. And equities, Tom, elevated through most of this morning. We're up by, let's call it a third of 1% on the S&P.
Right now, and this is an important conversation, all the kids are back in college, and every once in a while you get a kid that goes to school and they do what's called a double major. There's Williams, PP&E, and other schools around America. Wharton's got a wonderful double major in computer and business. And then there's South Bend, Indiana. They pieced together a couple years ago an economics double major, and one of the outputs of that is Madison Fowler. She joins us now, J.P. Morgan, London investment strategist there. Madison, South Bend, I know, steeped you and steeled you for the cacophony we're in right now. My head is spinning. What will you listen for from Christine Lagarde?
Sure. Thank you for having me. I think what's really key to listen for there is, are we going on to more of a hawkish hold, or, is it more of a dovish hike? And I think that's quite important. But I think at the same time, though, even going into this meeting, we did pencil in about one more hike from the ECB. for the balance of the rest of this year. And I think when we think about, is there a debate over whether it's this meeting or whether it's in a future meeting, I think the ECB is very clear that they want to be closing this chapter on rate hikes. But I do think that Lagarde will be really trying to preserve that optionality. And so I do think that she'll be using uncertainty as a tool in order to do that.
Madison, are they confronting stagflation?
I think the risks for stagflation are certainly higher in the euro area than they are in the U.S., for instance. So the ECB is in a tough spot because we've seen growth start to, I think, unwind more quickly than expected. You can see that in the PMI data, especially the services figures, which have decelerated more quickly than anticipated. But at the same time, inflation remains quite high. You have both headline and core prices still above 5% on a year-over-year basis. So that's quite difficult from a policymaker standpoint. We still do think that inflation will continue to cool over the balance of the year as the labor market should hopefully cool. We are seeing a rise in some of the unemployment numbers. But yes, to your point, the stagflation risks are certainly higher.
They're set to forecast inflation above 3% for 2024. Madison, do you see it coming below that by year end next year?
I think it's difficult. I certainly think that if you don't see inflation fall more quickly, I think the conversation is certainly going to switch into how long does the ECB need to hold interest rates at this really elevated level for. And from that perspective, I think it's really difficult to see the ECB starting to cut rates really at all in 2024 until you start to see that inflation number start to move lower.
That said, there was something that Mark McCormick of TD Securities said, which was highly contrarian, where all of this, yes, higher than expected inflation comes on the heels of stronger growth in Europe than the U.S., which is his prediction. Can you get on board with that?
I think it's harder to see higher inflation if growth is weakening in the euro area. So at some point in time, these two things start to reinforce each other. And so if you see growth momentum continue to weaken quite considerably in the euro area like we are today, at some point in time, I think you do have to think that inflation is going to follow. It's just going to take, I think, a little bit longer than people were otherwise anticipating.
So do you think that right now what we're going to hear from the ECB, from Christine Lagarde, is patience? Are we going to hear this sense that you can wait and you can see how things progress and maybe just pull a Jerome Powell and basically hint that it's okay if it takes until 2026 to get inflation down to 2%?
Yes, I think that's fair. I think that's part of the reason why they're using uncertainty as a tool in order to preserve that optionality of doing that. But I think so long as they are seeing continued progress towards, moving towards those goals, I think that's a positive indicator. And I do think we also need to keep in mind that the ECB is a single mandate central bank with price stability, that 2% inflation goal, really important to them.
Away from the ECB remit, Madison, I'm fascinated by the JP Morgan position in the continent of Europe and the United Kingdom as well. Do you find U.S. equities relatively attractive right now from your desk in London?
I think in the short term, yes. I will take a step back. At the start of the year, we did come in with a view for European equities to outperform the U.S. from a broad market basis, and I think that did track. But as the euro area economy started to slow, as we saw momentum shift, we, I think, transitioned that call away from the European broad market and more so into European national champions, which are companies that are based in Europe, but multinational companies that are leaders of their industries and are still demonstrating a degree of pricing power. So I think it's more about where in Europe you're really focusing rather than a U.S. versus Europe conversation.
She has the chat so down. If you say something tracked, that means you sort of kind of like got it right. That tracked.
I think Novo Nordisk. When I hear her talking about those themes. Madison, thank you. Madison Fuller there of JP Morgan Investment Bank. With us around the table, I'm pleased to say, going into this rate decision from the ECB, Eric Nelson, macro strategist at Wells Fargo. Good morning to you, Eric. Rate hike or no rate hike from this ECB in 5 minutes' time?
We think it's a pause, John. Obviously, finally balanced, and we had the Reuters decision the Reuters report earlier this week. I would not say that this is something that I'm fully buying into as a signal of what the committee is actually going to do. And look at the speech from Schnabel a couple weeks ago. I thought that was actually pretty balanced. I think if she really wanted to push for a hike, she would have. And I think she's probably the most prominent hawk on the committee at this point.
So question. forgive me for asking this because we don't really know the answer, but why do you think they leaked it? What do you think the purpose of doing that was?
The question is, who's they, John? Was it a rogue hawk or two who wanted to push for a hike and push pricing, or was it, the overall committee? And that's what we really don't know.
There is this question, though, of whether they're going to emphasize patience or whether they're going to emphasize their primary mandate, at least in name, which is inflation. What would be the justification for a pause, given that inflation really hasn't come in as much as they expected, especially if they increase their inflation forecast for next year?
Yeah, this is challenging optics, right, Lisa? I think you have to look at not just the growth situation, but also the pace of hikes. Right, they've done a lot of tightening, almost 500 basis points, 450 basis points or so. They've come from negative territory. So I think even just skipping here is justifiable, even with inflation where it is, given the growth outlook. The question is, how do you communicate a pause?
I mean, we just got moments ago West Texas Intermediate through $90 a barrel. The Eric Nelson rally in Brent continues. We're at $93.27 as well. What's the so what here for Americans? You've got great perspective on this. Why do Americans care about Europe in a monetary and not even having a combined fiscal policy mess?
Yeah, I mean, certainly it's a massively important economy in a broad global scheme. But I think if you look at the sort of the policy outlook here, right? I mean, you have the ECB having done almost 450 basis points, and you really are seeing a spillover into the economy, the real economy now, the credit conditions. The question is this something we should be thinking about for the U.S. as well? And you look at lending standards, you look at lending conditions in the U.S., you are starting to see some transmission of policy.
John, anecdote as we await for the ECB decision.
You price in hotels
in Paris,
now.
A hotel in Paris, $480.
Oh, boy.
And then the demand of it is now $800. And I just looked, and it's just under $1,300.
It's getting expensive.
For the same damn room I stayed in at $480 not that long ago.
That's the foreign demand.
That's the American madness about Europe.
Let's talk about domestic demand. Can domestic demand in Europe hold up? Look at where the euro is. Look at where crude's trading right now. The euro's at 107. Some people, Nomura, call him 105. Crude's through 90, WTI through 93 on Brent. Surely that higher energy price, that weaker euro, it's just brutal for the Europeans at the moment.
It's a nasty mix, John. I think the question, and back to Lisa, you brought this up with Mark McCormick's comment about relative growth. The question is not so much obviously you want to know what's happening in domestic demand in Europe and, on an isolated basis, but on a relative basis. Can the U.S. recession be deeper than Europeans' recession in the first half of next year? That's certainly possible. From a real policy rate standpoint, can the Fed cut more than the ECB next year? I think absolutely. So that euro, dollar story can turn as we get toward the ends of the year. But right now, where I'm sitting, it looks pretty negative for the euro.
So 105 in sight for you next couple of months?
I think 105, 106 is where we head.
But for next year, what are you thinking about?
I think we can see a rebound back toward 110.
Okay. It's a pretty tight range, though, isn't it? 105, 110.
Yeah, but these guys do. They play 2 pennies. You and
side.
I are looking at like big decisions.
I wanted some big numbers, Tom. 115, 120. Here's your guide for the next 45 minutes or so. In about 2 minutes, an ECB rate decision. 15 minutes after that decision, some data in America. US retail sales, PPI, jobless claims. Jobless claims last week, the lowest we've seen going all the way back to February. They've come down, down, down over the last month.
And they model it back a survey from what, 216 back to 225?
Still
exceptionally low. Do they just guess that? Is that like a dartboard guess? How do you do that?
TK, without a doubt, Bramo, we do call that a guess, don't we?
We always do. I mean, honestly, this is just basically a rough estimate, which is the reason why nobody really trades on it that much, unless they do, in which case, if it comes out surprising. I think retail sales might be the most important event, though, of the day.
I heard people say that in anticipation of CPI, that maybe more than CPI, retail sales was like the data point of the week.
100%. Couldn't agree
more. The
more.
countdown clock says we're selling the ECB nut right now. We sell retail sales after.
It's related.
I was trying to do
it's
that.
It's actually related, though.
I was going through the clock, Tom, the next hour, and then you'd wanted to talk about claims and all that good stuff. So the ECB in 30 seconds, data after that. After we get that data at 8:30 Eastern, I'm going to complete this. 15 minutes after that data, you get a news conference with President Christine Lagarde. Going into this rate decision from from the ECB. We're split right down the middle. No hike or hike. You take a guess at home. Going into it, the euro looks a little something like this. On euro dollar at the moment, we're at 107.31. We are totally unchanged on the session as we anticipate this rate call from the ECB. I'm looking at the German curve with yields coming in a basis point or two right across the curve. The 2-year in Germany at about 3.15. The 10-year in Germany down about a basis point. There is your rate hike from the ECB. They come in with a 25 basis point move. We go from 3.75 on the depot rate to 4%. On the marginal lending facility, we go from 4.50 to 4.75. On the main refinancing rate, we go from 4.25 to 4.50. It is a 25 basis point rate hike from the European Central Bank. We were split right down the middle on no hike or hike. We get that hike. The euro looks a little something like this, actually dropping and weaker against the dollar, 107.10. We're negative here, Lisa, by 0.2%.
Seeing inflation this year at 5.6% versus the prior forecast of 5.4%. The key here will be communication at this point. Is this the last one? Is this going to be Christine Lagarde coming out and saying, this is it? We're now going to wait. And that might be a cleaner message than a hawkish pause.
The call for 2025, they see inflation slowing to 2.1% in 2025. So, Tom, what we've got here is a 25 basis point hike and a ton of estimates as well. The growth estimate for GDP, Tom, for 2023, there it is, 0.7%. The previous forecast, 0.9.
Lawrence Summers walked by me yesterday in our acclaimed food court. We enjoyed greetings. And this is a Larry Summers report. And the basic idea here is inflation. No, the growthiness of this will be on the data screen in 10 minutes.
We've got Maria Tadeo alongside us in Frankfurt, Germany, inside the headquarters. I just want to share with you the lead paragraph from the statement. Inflation continues to decline, but is still expected to remain too high for too long. The Governing Council is determined to ensure that inflation returns to its 2% medium-term target in a timely manner. In order to reinforce progress towards its target, the Governing Council today decided to raise 3 key ECB interest rates by 25 basis points. Maria Tadeo from Frankfurt joins us right now. Maria, what stands out for you?
Well, Jonathan, it is a hike, which, as you see, there had been a lot of volatility in market sentiment. But of course, it was that report that came out by Reuters. Then Bloomberg confirmed it, that the European Central Bank saw inflation actually spiking next year in 2024. And that was a crucial year, Jonathan, when it comes to the transmission. The entire decision, and we talked about this many times, hinged around the idea of transmission. If you believe transmission was strong enough, you could pause. If you believe it had not, then there was a case to make this rate hike. I think, to me, it also makes sense because, Jonathan, when you come out with a report like that 48 hours before a decision, you completely change sentiment in the market and provide this platform for a hike. Today would have been a massive U-turn not to hike. The other thing to me that is interesting now, beyond the actual decision, but the language, is that they reinsert this idea that the European Central Bank will maintain sufficiently restricted levels when it comes to their monetary policy. Again, it is always a balancing act. They hike. It sounds hawkish. I wonder, though, in this press conference, how is Madame Lagarde going to balance it out with an economy that clearly is now in a downturn, and they're hiking into this downturn. And it's not just Germany and manufacturing. We should make that clear. It is now spreading across the euro area, and it's also now spreading into services. So it is an economy that is weaker. And this is a nightmare scenario they said they wanted to avoid, by the way, when they started hiking into a downturn.
The elephant in the room right now is the energy story. Maria, I'm just working through the forecasts in their statement, so let me share it with our audience. The September ECB staff macroeconomic projections for the euro area see average inflation of 5.6% in 2023, 3.2% in 2024, 2.1% in 2025. An upward revision for 23-24, downward revision for 25. And as they point out, the upward revision for this year and next year mainly reflects a higher path for energy prices. How much of this is about domestic price pressure, and how much of it is about just being exposed to this higher energy story?
Well, look, this is a complicated picture for the European Union, because we know it's not just the energy prices now, which have dropped dramatically and significantly, but it really is the second round effects, the repercussions and the fallout that is done for the European industry. Again, you're at the mercy of a complicated energy space for the European Union, and they're very clear that as long as the war in Ukraine continues, and I am sure she's going to reference this war, they are facing a volatile scenario. The other issue, of course, that features into the energy story is the implications for growth. Again, they're cutting their growth projections, which again should not be a surprise because you had Paolo Gentiloni on the show, and he already did that and cut their forecast for growth. The question is whether we're heading into stagflation or not. That is a word that, for the time being, everyone wants to avoid.
Well, Maria, you're living this viscerally. I mean, you're really, really steeped in this. Dovetail the growth forecast markdown, essentially a run rate of 1% to be charitable for 36 months, with oil at $93 a barrel. It doesn't compute. To me, the inflation story's almost been pushed aside.
Because the growth picture is bleaker. And again, that was the whole argument, Tom, and you make a good point as to why this market was split. And not just the market, but really the governing council going into this meeting, again, suggesting this is an economy that is weaker. There is obviously a downturn that is manifesting. And of course, this is a single mandate central bank, but it doesn't operate into oblivion. It does it in a way where obviously the economic perspective matters. And again, it goes back to this idea and some of the criticism of the ECB, I should point, from a number of countries, that they missed an early window to hike. Then obviously inflation was not a one-off, but it was entrenched now in this economy. And now they find themselves in a situation where the prospects for growth are challenging. They're difficult, of course, and you continue to hike. So yes, Tom, it's not just about the inflation. I think it's a very fair point to say the economy also featured in this conversation, not so much to tip the balance. Obviously, the European Central Bank has now gone for this hike. The question, though, is whether she signals this is the last one, precisely because all of the issues that you mentioned.
There's a strong hint of that in the statement. Maria, thank you. Maria today out there in Frankfurt. So this is what you've got. 25 basis point hike. Upward revision to the forecast for headline inflation for this year and next year. Downward revision, actually, for core CPI. The bulk of that, an energy story. A cut to the growth forecast for every single year, basically. They now expect the Eurozone economy to expand by 0.7% in 23, 1% in 2024, 1.5% in 2025. You're about to get a strong hint of what you may hear in the news conference with Christine Lagarde from the Governing Council for the ECB. This line right here, Tom, based on its current assessment, the Governing Council considers that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Is the ECB telling us they now believe, based on their forecast, they are sufficiently restrictive?
I'm in the camp where you're dead on, and they got a single mandate. I get it. It's a different set of rules than Jerome Powell has. But to me, John, everything has been overwhelmed in our analysis by oil over the, I'll say the last 2 weeks, but frankly, over the last 3 months, let's call it. And the growth forecast, to me, I know it's not what they do. We're not supposed to talk about it. Rates. You know what? They're in recession.
Energy is at the heart of this. The growth outlook is absolutely terrible.
Yeah.
The market at the moment, I think, picks up the scent that they're done. The euro's weaker off the back of it, break of 107, 106.97. That can change in the news conference, of course. You look across the German curve here, Lisa, got a move of 5 basis points to the front end. On a 10-year, you're down 6. The 2-year is back to about 3.11. That's the initial knee-jerk reaction off the back of that statement.
Well, it's easy to read the statement that way, also saying that past rate increases continue to be transmitted forcefully. In other words, the rate increases are still acting with some sort of lag.
Eric Nelson, your thoughts on this one?
I think the market's telling the story right now, John. You look at the yen, and it's strengthening pretty meaningfully against the euro. The growth fears here clearly accelerating. To Lisa's point, policy transmission working its way through. And to your point, John, this sounds like they're done. Now we'll have to hear what Lagarde has to say. I think the market will still be in flux here. But if they communicate this as a one and done, I don't see how the euro rallies here.
How much are they going to try to signal that the inflationary push is entirely from energy, and they've got to be cautious with that? Really lean into that story, given the fact that they actually downgraded, as John was saying, their core expectation for inflation both next year and the year after.
Yeah, I think that's certainly a sensible thing to do. I think that the challenge here, though, is if that's the communication you opt for, then why did you hike today? If the upward inflation revision for 2024 is mostly energy-driven, and supposedly you hiked on the back of that. I think you have to balance that communication. So, look, it's a single mandate central bank, but they do have increasingly focused on credit conditions and growth, and I think they're becoming more concerned about things on that side.
Before we got this, you said that you expect it to be sort of in a 106, 105 range for the euro. We're already breaking down from that 107 level, 106.97. Can you revise your forecast based on this preliminarily, just sort of like back of the envelope? Does this make you more bearish on the euro than you were before this announcement?
I do want to hear what Christine Lagarde has to say. But I think if this is a one and done, and the GDP forecasts are coming down, and this is the way they want to play this, look, maybe you do get a bit of a short squeeze into the next couple days. If it's hawkish and there's reason for rates to in the short term at least to move higher, but I continue to want to fade that. And I think the curves will keep flattening, and we'll be back at 106, 105 in a couple days.
With your Johns Hopkins economics, you know that Keynes was right. When the facts change, Eric Nelson changes. What does this oil and growth matrix of Europe do in the foreign exchange space? To me, we're a place where we weren't 2 weeks ago. Certainly we're at a place we were not at the end of the summer, call it August.
Yeah, I think part of it, Tom, of course, is the oil story, but also thinking about natural gas prices, right? So,
thank you. Well said,
let's talk about both of those. I mean, on the oil front, it's only gotten worse, and it's probably going to get worse before it gets better. So that's Euro's being one of the largest energy importers and oil importers out there. It's going to be another downside risk. But the question is, what happens to gas prices? And storages are still quite full. There's a lot of people worried about European winter and natural gas, and to the extent we see that gas prices actually go the other direction, head lower, could be a bit of an offset to think about.
Let's put a bow on this and just reflect on where we've been over the last 18 months. It's easy to get carried away. We've got a strong suggestion here the ECB might be done. They're going to say they're data dependent. That could change. We may well hear that on repeat from President Lagarde in 20 minutes' time. Did you ever think they'd get to 4% on the depot rate when this all started? I never dreamt of that. I never thought we'd get anywhere near 4%, and here we are.
Absolutely, John. I think I remember back in 2021 and 2022, I think people thought that 1 or 2% would have been, kind of the 2011 moment or the 2008 moment, right? Another farcical hike.
It may well still be.
It's possible. It's possible. But look, this is there's been a lot of tightening done here, and I think you're seeing it really filter through here, more so than you're seeing in other economies, and I think that speaks to the sensitivity and also the level of neutral rates in Europe.
Raises the hard question. We had a decade, the best part of a decade of negative interest rates and QE forever. Are we ever going back? Are we done with that now?
Not for a long time, John. I never say never, but I think the genie's out of the bottle here. I think the question here is, especially if we're looking at even the BOJ is talking about rate hikes, and that tells you where we are.
What a change. What a change. Eric, great to experience it with you. Eric Nelson there of Wells Fargo. If you are just joining us, this is what we've had from the European Central Bank, a 25 basis point hike. We take the deposit rate from 3.75 to 4%. They've upgraded the outlook for inflation for this year, for next. They've actually had to bring in the outlook, take it down for core CPI. All of this, a strong suggestion that driving that headline story is crude prices, it's energy. The growth outlook is absolutely dreadful, but ultimately the next move, TK, sounds like a pause, looking at this ECB statement that we get this morning. And I'll share that quote with you all again. Based on its current assessment, the Governing Council considers that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Are they done? I'm
going to go back to Keynes. When the facts change, I change. Lagarde has changed. She's not the same Lagarde as at Jackson Hole. Absolutely flat out. The way oil's moved here, the way the Saudis have manipulated the price, she goes up on stage today different than the conversation at Jackson Hole.
She has a free pass to pause, to actually be done now, because this is what the market is expecting, for her to be done. And
She's
this is what the market is processing.
And you're right, the single mandate's overwhelmed.
So at this point, she can come out and say, we want it to be sufficiently restrictive, not maybe in those words, in the not more fanciful words that you just said. We got there, and now we see. Now we wait, and we get a sense of how much this transmission policy is going to work through the system.
And with TK, though, Bramo, you get the feeling that in the last 2-3 weeks, Tom, this energy price move has really encouraged the hawks to go into the Governing Council meeting in the last couple of days and make a change. It'd be interesting to see what the thinking was behind this move, because we certainly didn't get a strong guide towards an interest rate hike, Tom, from President Lagarde when you sat with her in Jackson Hole, Wyoming. In no way, shape or form was there any suggestion at all they would sit down and deliver 25 basis points today.
And this is the heart of the matter, and Matt Boesler was great in the Lodge explaining this to me, Patrick Lane and all the rest of it. She wants a more omnibus 60,000 view, a longer-term analysis of what we're going to do. I get it all. Crystals and pyramids, great. That was the name of the speech, and I was honored to speak to her. You know what? oil moved. All of a sudden, it's like Mike Tyson hitting you in the face.
Yeah.
And I'm sorry, this is a different press conference than I expected, sitting there, waving with her at the Elk. Hi, Elk. How you doing?
Everyone's got a plan, Tom, until they...
And that's happening right now. And to Eric's brilliant insight, can that come over to the United States?
You said crude made a move. We're through 90 on WTI a little bit early this morning. The euro with a break of 107 at the moment, 107 flat, negative a third of 1%. The next stop for this story, data in America, retail sales, PPI, initial jobless claims. Mike McKee dropping by to get up to speed on that. Mike McKee, what do you see?
Well, let's forget about Christine Lagarde and what she thinks for a few minutes and think about what the market thinks Jay Powell will think, with retail sales up 0.6% on the month of August. That is significantly higher than the 0.1% that was forecast. Ex-autos up 0.6%. And the retail sales control group, waiting on that one to come in here. Hold on just a second. That's being calculated as we speak. A couple of other numbers. Initial jobless claims, 220,000. Now, we don't know what the revision is yet. It was 216 last week, but it does tell you that we're still in a very low claims environment. Continuing claims are at 1,688,000. PPI has just come in as well. PPI for final demand up 0.7%. That's a significant increase over the 0.3 the prior month and 0.4 expected. If you look at the core, which we look at as ex-food, energy, and trade services, that's up 0.3 compared with a 0.2 rise last time. So we are seeing some inflation pressures at the basic level of the wholesaler. So we are seeing some problems with inflation, but retail sales so far not being affected. Retail sales control up 0.1%. That is a lot less than the 1% last month, but it's better than the 0.1% decline that was forecast. So retail sales strong, jobless claims are weak, which could be translated as strong, and PPI does show some inflation pressures. You guys check the markets. I'll see what made up the retail sales report.
Mike McKee, thank you. It gets better for America just as it gets worse for Europe. Compare and contrast the front end of the curve in Germany and the United States. The 2-year in Germany, the yield is lower. In America, the 2-year is higher. An upside surprise on retail sales in America off the back of that. Yields up on a 2-year by 5 basis points. We're back through 5% on a 2-year. In the FX market, the euro 106.63. We're negative there by 0.6%. TK, what a mix in the last 15 minutes. Going into President Lagarde in about 13 minutes' time.
DXY, the blended average, I believe it's 54% weighted euro. DXY index, a traditional dollar index, is nicely through 105 and goes out to new highs over the recent number of months. Watching oil, it really hasn't changed off the shock of what we saw in the last hour. And, the bottom line with the news flow here, we just continue. We have retail sales. Michael, give us the control group. And then we got to go to Helene Becker's conversation earlier. Oh, yeah. Meanwhile, back at the races, Ed Bastian wanted to get into the news flow.
Energy at the epicenter of the outlook for inflation in Europe. It's at the epicenter right now for the outlook for the airlines in America. Just to get you up to speed on the latest from Delta, sees third quarter adjusted EPS of a range of 185 to 205. They had seen previously 220 to 250. They still see full year adjusted EPS of $6 to $7. The estimate there, 658, just marginally lower. We had some downgrades to the outlook yesterday from Spirit. We had it from the likes of Delta right now. We've heard it from American as well. It's Delta right in front of us at the moment. You put it all together at the moment, it's all about energy. Higher fuel prices hitting the airlines. In Europe, it's hitting the outlook for inflation. Lisa, in America, just as the ECB comes out 15 minutes ago and downgrades the outlook for growth for every single year, we print a big upside surprise on retail sales in the US.
This is almost the worst case scenario for the euro heading into this. What would have been worse is if the ECB had come out and not hiked rates and said that they were done. Otherwise, basically, this is exactly what people did not want to see. The US outperforming and the European region showing itself as not flat on its back, but something like that. The clarity here to me is that the US economy has enough momentum with the surprising data to the upside again and again to withstand the higher oil prices. Does Europe? And that, to me, is one of the key questions at a time where they're battling both inflation and waning growth.
Yeah, I look at it and it's just a great day for news flow. This is a really key day in the year, John. I mean, it's just
That's
all
pretty
the
amazing,
things
TK,
going
yeah.
on. It's amazing. I mean, your head's spinning. There's
Let's
no
put it
other
all
way
together for you.
to put it.
If you are just joining us, I'll do my best to wrap up the last 20
luck with
minutes
that.
or so. 25 basis point hike from the ECB. We were split right down the middle. The outlook for inflation for next year, above 3%. That was widely expected, according to reports we had going into this ECB rate decision. The outlook for core, actually take that in a little bit. The bulk of this move for headline inflation in that forecast is all about this move in energy. And that contributes to this downgrade to the outlook in the third quarter for Delta. Then we get the US data. US data surprising to the upside. Retail sales strong, headline 0.6%. The control group, plug that into GDP, positive 0.1% for the month of August. The estimate, negative 0.1. So things better in America, worse in Europe, and they might have to stop raising interest rates because the growth profile is absolutely terrible. Yields are up on a 2-year in the States by 5 basis points and back through 5%. In Germany, the 2-year is lower by 3 basis points. So yields up stateside, yields down in Germany. What does that mean? Stronger dollar, weaker euro, breaker 107 in the last 15 minutes, 106.66. All the wrong numbers over in Europe right now, TK. That currency pair down 0.6%. And it's up to President Lagarde to pick the message in about 10 minutes' time.
We're going to see that from Christine Lagarde. We welcome all of you on Bloomberg Television and Bloomberg Radio. And this is a great honor. Just as a small aside, I was with John Riding when we learned of the Madoff scandal. Far before that, he wrote essays in economics that synthesized his Bank of England, his Fed, long ago at Bear Stearns and now at Breen Capital. And to have John Riding with us on this historic moment for the ECB is an honor. John, one of your great, great essays was The Putting Green of the Fed. Is Christine Lagarde on the golf course? And does Christine Lagarde have any clue where the pin is on the green?
Well, Tom, thank you for referring back to a note that I think goes back to 2004, maybe earlier, so no one knows what we're talking about. The idea
That's why the show's so popular.
The idea was, back at the time, the Fed was making very small moves in raising rates, and Bernanke was talking about lagging the putts, but I was saying that, are they even on the fairway? Because they were so far from neutral. Now, this is a very different story. We are clearly on the putting green. We're certainly on the putting green in the U.S., and maybe it's a gimme come next week. Some of these inflation numbers, a little bit of a warning with CPI yesterday and PPI today.
You live this. You live this at Bank of America. Yeah. They invented the ECB. Duesenberg came in. Trichet, John screwed up. Is that the proper answer?
Had a couple of difficult moments in 08 and 2011.
This is an historic moment for Lagarde this morning. You say she's on the putting green?
No, I said the Fed was clearly on the putting green, and maybe it's a gimme. The ECB, I still think, is probably a chip shot away from the putting green, but they're not driving off. They made a huge adjustment. But inflation in the Eurozone's 5.3%, projected to go higher. It's still significantly above the policy rate, so they have negative real rates. Now, I know that rate hikes can't do anything about oil prices. Rate hikes can't make the winter milder in Europe and ease any potential gas situation. But a mistake that was made in 2021 by central banks around the world was in allowing supply chain issues, energy price issues, then war in the Ukraine issues to filter in to the broader price-setting behavior. And that's what central banks have to push back against. I think the Fed so far has done a pretty good job. I think the ECB isn't quite there yet. Well, and I think they have to be very careful not to tell the markets that they're there and that this is the last rate hike. Because what do markets do when you think you've got the last rate hike is you look for the first rate cut, and that's way too premature. Just a word on those retail sales. Not quite as strong as you think, because I believe there was a downward revision to the July increase in the control group from 1% to 0.7%. I don't know what the June issue was, revision might have been, but the U.S. consumer is strong. In the third quarter, GDP now was 4%. I don't think it's probably going to, for consumers, real consumer spending, I don't think it's going to change very much on that, the Atlanta Fed's estimate. It's not that the U.S. is roaring. It isn't. But it isn't yet falling into recession, perhaps unlike the Eurozone, given the size of the interest rate adjustments.
Is the big takeaway here that the central banks are almost done, or pretty much done, and now we have to look at the underlying economy and how strong the economies are, and that Europe is not nearly as strong as the U.S., cannot withstand the oil price shock that might be coming down the pike, and thus is in a worse position with the euro set to fall?
Well, I think the Eurozone is in a worse position, and then you have fiscal issues in a number of countries. There was some brief mention of Japan. I would say that Japan is in an even worse position because they haven't even begun to consider hiking rates yet. And yet they've got an underlying inflation rate that continues to go higher and is above 4%. So if the U.S. is much better placed than the Eurozone, which is, as I said, maybe it's a chip shot away from the green of monetary neutrality, but the Bank of Japan's still in the clubhouse.
They're in the bunker, the ball's plugged. It's so much worse than you're describing. Surely, in Europe right now, they've had to downgrade the growth outlook. They've had to upgrade the inflation outlook. They're basically doing their best to signal the pause without signaling a pause. Do you sense any decisiveness out of this governing council whatsoever this morning?
I don't know. We'll have to listen to the press conference and the questions and see where that goes. But let me just go back. Back in 2021, maybe even in 2020, when all of these extraordinary efforts during the pandemic and much needed were being done, I warned multiple times that if you do too much or you don't pull it back soon enough, you're going to end with an inflation problem. So the consequences of what we're seeing now isn't the consequence of the ECB hiking to 4.5% from negative rates. It's that they left those rates there too long, as the Fed did. But the Fed did a better job of catching up. And that puts them in a better position now. I think the ECB still has a little bit of catching up to do. And yes, there's probably a recession out there, may well be in recession, but you know, it's like omelets and eggs.
I got to squeeze this in. John's going to go to Lagarde here in 3 minutes, so we got about a minute and a half for a killer question for our audience. You nailed that we would have higher inflation. It took a while to get here, and maybe the path was stranger than we thought, but you nailed that we would get to this point. Should our listeners and viewers be afraid of the new rate environment, or can America adapt and prosper in this rate environment?
I think after the adjustment, America can adapt. I don't think we're going back to the very low interest rates that we had pre-pandemic. You just look at the housing market. You've got a 7.5% mortgage rate. And I bet if you ask most people a couple of years ago, mortgage rates were 7.5%, what would the housing market be doing? No, I don't think anyone would have imagined it could be as strong as it currently is. Now, that's not to imply everything's rosy. And I still think the U.S. faces a recession in 2024, but the glide path to that is so much stretched out because of all the cumulative excesses. The large number of jobs, 1.4 jobs still for every vacancies for every job seeker. Still a little bit of excess savings from the pandemic, but that's mostly worn down. It's a very, very long glide path. And I just think people might let the guard down a little bit too soon on the recession chances as some firms have, I think, for 24.
Okay. John, I don't remember the last time we had a 20 minutes like the one we've just had, Tom. Last 25 minutes or so.
This is a huge
Incredible,
deal.
right?
It's a huge deal. Yeah,
tons of economic data stateside. Want to get back over to Mike McKee just for a second look at the data we had in America. Mike, big upside surprise on retail sales.
And an upside surprise on PPI, and both of those attributable to oil. You guys nailed it at about 8:28 this morning, just before we got the data. Oil prices driving this up. Gasoline station sales up 5.2% in the month of August compared to just 0.1% in the month of July. We did see in retail sales a number of things that point to pretty much normality, including a 0.9 rise for the second month in a row in clothing and a 0.5 rise in health and personal care. So people got their haircut, they bought new school clothes. It was a typical back-to-school season. The other thing in PPI, it's a 2% rise in the price of goods, which the Labor Department attributes to oil prices, 60% of that rise. to oil prices. So PPI being pushed up by oil, and so are jobs, so are retail sales, rather. The jobs numbers, 220 for jobless claims last week, revised to 217, so a slight rise, but still historically low. So at this point, it is hard to see a lot of bad news other than energy in these reports this morning.
Mike McKee, thank you, sir. As Lisa mentioned privately in the chat a little bit earlier, 1-2 punch for the euro right now. Data great in America. In Europe, I've got no idea what the outlook is. For inflation, it's higher, on headline at least. For growth, it's lower. The euro, a break of 107, 106.81, as we anticipate that news conference beginning with ECB President Christine Lagarde.